Hello everyone, this is Bhavik Chokshi here. I hope you guys are doing great. In today's video, we would be discussing about the all-important CA Final November 2023 RTP. So what I've done over here is I've kind of done a bit of breakdown and analysis regarding what is there and what are the important sections of this RTP. So just as an overview, the RTP comprises of two parts. The first part is amendments, which is usually something which kind of scares the students. To be honest, the amendments has three subparts. One is, as I've outlined over here, based on a notification which was issued on 31st of March 2023. There are two or three small changes, though I don't really see any significant differences from an exam perspective. The other two, the notification issued in September of 2022 for CSR, which is exactly the same as what we discussed in the May 2023 RTP, and certain notifications which were given in the last year, I think on 23rd of March 2022, which was reproduced and given in November 2022 RTP is just given the same. So you might see a good 15-20 pages of amendments. To be honest, the CSR amendments as well as the 2022 amendments are exactly the same. They've just been reproduced again. Having said that, not very significant from the exam perspective. In today's session, we will also be discussing about the 31st March 2023 amendments and just giving you a quick overview about the older amendments as well. In any case, we have a separate YouTube video for the same. I'll share the link as well in the description. Then comes to the topics. So as always, you have 20 RTP questions. A few of them are quite intense. A lot of these are similar to the past institute study material or RTPs and consequently same as our material. So what I've tried to do is I've tried to segregate and give you a quick one-pager reference so that you know which questions you want to refer. In this video, we will try to discuss all the 20 questions. Yes, it will take some time, but we'll give you timestamps in case you want to refer the important ones only. We'll focus a lot more on the new questions or questions which have been modified, and probably just kind of give you a quick overview and discussion on questions which are already there in the study material or in our material as the case may be. So over here, a few questions have been taken by the institute from the diploma IFRS, DIP IFRS material, from the GFRS material, etc., and hence might appear to be a little intense, but nevertheless, no problem, no harm in kind of reviewing interesting questions at least before the exam. You don't want to see this in the exam for the first time. Before the exam, it's fine, we'll manage everything. So over here, what I've tried to do is I've tried to highlight the questions which I think are slightly difficult or slightly different from what you would have done and important. Again, institute carries forward and continues its trend of modifying questions which appear to be similar to materials that you have seen. Having said that, a few interesting adjustments have been put in. So even questions which involve modifications, I've highlighted, like you have question number 2, which is based on foreign currency translation reserve, which is there in the institute material, our material as well, but there are a few interesting adjustments in that as well. So the important questions in RTP would be question number 1, question number 2, question number 4, question 6, question 7, question 11, question 12, question 13, 18 and 19. So maybe out of the 20 questions, 10 of them are quite interesting. The other 10 you should refer if you have time. Otherwise, you can at least focus on these 10 in my understanding. So first we'll try to finish off the questions. Then we will go to the amendment discussion. So let's dive into the RTP. Let's go to question number 1 on page number 10 of the RTP. So let's get started. This is on Ind AS 103. Now, Mini Limited is a manufacturing entity in the textile industry. Mini decided to reduce the cost of manufacturing by setting up its own power plant for their captive consumption. Fair enough. As per the market research report, there was a non-operational power plant in the nearby area, and hence it decided to acquire the power plant, which was having a capacity of around 80 megawatts along with the entire labor force. Okay, so an important point over here, you are acquiring the power plant along with the labor force. So generally when we look at business purchase versus asset purchase, you usually look at the fact that whether you are acquiring an entity along with the labor force. So over here, this is a non-operational power plant, so probably it is not currently generating output. However, it has the capacity to generate output, and hence can we say it is a business or not is what has to be reviewed. The power entity was owned by another entity, Max Limited. Mini Limited approached Max for acquisition of the 80 megawatt power plant on the following terms. Mini will seek an independent valuation for determining the fair value of the 80 megawatt power plant. Okay. Value of the other non-current assets acquired and other non-current financial liabilities is 11.1 and 32 million respectively. Consideration agreed between both the parties is rupees 51 million. So this is basically PC, purchase consideration. This seems to be a part of the net assets taken over. This also seems to be a part of the net assets taken over. A couple of points that we need to know over here is, if independent valuation report is sought and it is still not final till the acquisition date, there is a concept of measurement period in business combination that applies over here. So the measurement period concept says that in case you get additional information within a 12-month window pertaining to conditions which are already existing as on the acquisition date, you will adjust the corresponding goodwill. So that is one thing that you need to remember. Both parties agreed to the terms and entered into an arrangement on 1st April 2011, let's say 2021, 2011, 20x1 as the institute usually writes, with immediate effect. So as a result, we can say that this is the acquisition date. 1st April 20x1 is the acquisition date. Due to unavoidable circumstances, the valuation could not be completed by the time Max Limited finalized its financial statements for the year ended 31st March 20x1, that's just a day before the acquisition date. Max's annual financial statements records the fair value of 80 megawatt plant at 46.9 with the remaining useful life at 40 years. So remember, this will be the value as per Max Limited's financial statements. However, we have been told that Mini will seek an independent valuation, not valuation based on Max's financial statements, for the fair value, and hence we can say that, well, for the time being, this 46.9 can be the provisional fair value. The provisional fair value for the purpose of determining goodwill. And if the independent valuation report comes within 12 months, it pertains to a condition as on the acquisition date, it can be taken as an adjusting event which will adjust the goodwill as well. Max also has a license to operate the power plant which is unrecorded in the books. Well, so be it. In the individual financial statements, it may not be recorded. However, if a fair value is attributed, then as the date of acquisition, you should be considering it at fair value as per Ind AS 103. As on 31st March 20x1, the fair value is 5 million. Okay. So this will be a part of net assets. This will also be a part of net assets. 6 months after the acquisition date, Mini Limited received independent valuation which estimated the fair value of the 80 megawatt power plant at 54.9. So this is after 6 months, and hence this is within the measurement period. So a measurement period concept will apply over here. Okay, it pertains to a condition existing as on the acquisition date, and the new information is availed within 12 months from the acquisition date. CFO of Mini Limited wants you to work upon the following aspects of the transaction. First, determine the transaction should be accounted for as an asset acquisition or a business acquisition. So the initial starting point over here, at least as per the revised, modified definition of Ind AS 103 for business, would be you start with something called as an optional concentration test. So if the question specifically tells you about you having to take the concentration test, that is when you usually take it. In general, if you see any of the institutes sums, they do not take the concentration test unless the question specifically tells you to do so, and hence the question has not taken or reviewed the optional concentration test over here. Having said that, if you want to review and check, you can do so. The institute has not taken that because the question has not asked you. It's an optional concentration test, so the question has not asked you. So we'll first review it as a business, and then if required as an additional understanding, we'll see that what if the question had also asked you to check for the optional concentration test. Okay, so asset purchase or business purchase. Let us say we directly evaluate whether there's a business purchase or not. So over here, the law says that there has to be, business is an integrated set of activities. Integrated set of activities, that is inputs, which along with substantive processes have the capability to generate output. So over here, if I look at inputs, we can look at inputs comprising of the power plant plus the labor force. So the labor force can be considered to be having substantive processes, operational know-how, and it has a capability to generate output. Let us say the power. It may not be currently generating the output, but it has a capability to generate output, and hence this can be constituted as a business. So over here, one of these conditions is that there has to be critical processes that should be taken over, that is labor force and inputs along with organized workforce, and hence this can be treated as a business. Now alternatively, so institute treats this directly as a business purchase without going into the depths. It treats it as a business purchase, which is fine because you are taking over the power plant along with the entire labor force. Having said that, if you want to look at the concentration test, in the concentration test you have to look at the gross assets taken over and see if the value of the gross assets taken over is substantially concentrated in a single asset. So the formula for gross assets taken over is the PC plus NCI plus liabilities. While taking the liabilities, you exclude the deferred tax liabilities and then you also exclude the cash. The derivation for this, I think in our business combinations question 75 or so, we have discussed this. Also, if you have to look at the gross, so the PC over here is 51 million plus, do we have any data regarding NCI? No, which means we assume 100% stake is acquired, NCI is 0, plus the liability. So the liability acquired over here would be, let us say, I guess 32 million. There is no data regarding deferred tax liabilities, there is nothing given regarding cash, and hence if you total all of this comes to about 51 plus 32 approximately. I'm just taking approximate workings. This is 83. Now, is the value concentrated in a single asset? Well, as it appears now, the power plant constitutes close to 46.9, I guess 46.9, it is as on the acquisition date, it is around 46.9 million. Power plant is 46.9. Even if you go to see, it is 54.9 later. Either ways, 46.9 on the base of 83, that comes to approximately 56.5%, and hence the value does not seem to be concentrated in a single asset, and hence it is definitely not passing the concentration test. If concentration test is not passed, in any case you go to assessment for a business. ICAI has not considered this. Having said that, you can consider from an exam perspective, unless it is specifically asked to check for concentration test, institute does not check it. Okay, so that is sub point A. Sub point B, calculate the goodwill or the bargain purchase gain due to the above acquisition. So if I were to look at the goodwill or the bargain purchase gain in sub point B, let us say as on 1st April 20x1, how do you calculate? Well, we do PC plus NCI minus net assets. PC is 51 million, there is nothing provisional, NCI is 0, and when I look at net assets, your net assets comprises of the power plant. The power plant currently is 46.9 plus other non-current assets, which I guess is 11 point something, 11.1, and minus non-current liabilities, financial liabilities, let us say this is 32. And as a result, if I go to see 46.9 plus 11.1 minus 32, okay, so this is 26. However, is there anything else that we have missed out? Well, yes, there is another asset which is not recorded in the books of Max, so be it. However, if there is a fair value attributable, there's an intangible, let us say something like a license, there's an intangible or a license as a case maybe, which you should be considering for the purpose of your assessment. So intangible should also be considered. So when we look at the total valuation, the intangible valuation, which is a license, let us say, will also be considered. So the license, I guess, is 5, and hence 46.9 plus 5 plus 11.1 minus 32 comes to, I guess, 31, and hence provisionally your goodwill will be determined at 20. So initially you will measure your goodwill at 20. This is at least as on the date when you are calculating. So this should initially be measured at 20, and pass the necessary journal entries in the books of Mini Limited as per Ind AS 103 and prepare the balance sheet as on the date of acquisition. So over here your journal entry, if you go to see, at least on this date, and then you will have to probably restate this on 30th of September 20x1, when your PC will still be 51, NCI will still be 0, instead of 46.9, this will be 54.9, all else remaining constant, 11.1 and 32. So if you go to see, this will probably be around 39, if I am not wrong. So this is 54.95 11.1 minus 32, this will be 39, and 39 and 51, PC remaining the same, will be 12. So there will be a difference of 8. This goodwill will be adjusted because Ind AS 103 allows you to make these adjustments during the measurement period. So if I had to pass the journal entry on 1st April 20x1, I will take over the plant, for example, at 46.9. I will also take over the license at 5. I will take over the other, I'm just writing this in short, non-current assets at 11.1, leaving a line or so to non-current financial liabilities. This will be at 32. Similarly, we will have to pay a consideration. Let us say consideration is paid in bank forms. It is, for example, 51, and hence there will be a balancing figure. This balancing figure will be in the form of goodwill to the extent of 20. Now, what happens to goodwill? Does goodwill get amortized? No, it gets tested for impairment. However, it does not get amortized. So, goodwill of 20 will remain at 20. However, what will happen to the plant? Now, ideally, this plant would be depreciated. The question has given you the useful life. And as a result, the plant would ideally get depreciated over the period of 6 months. Now, this depreciation would be based on 46.9. However, not just going forward, retrospectively, the adjustment is happening during the measurement period whereby your plant is to increase. So basically on 30th of September, you will pass an entry which will basically retrospectively restating the plant and the goodwill. So the entry for the same, if you go to see, would ideally be your plant will be debited. By how much will it be debited? Well, 54.9 minus 46.9. So the plant gets debited, I guess, by 8 to the goodwill. Goodwill over here will be credited. Goodwill will be credited also by 8. So goodwill is reduced by 8, plant is increased by 8. And as a result, there would be certain additional depreciation. So when you calculate your additional depreciation, let's say depreciation, which will go to the profit and loss account, depreciation account debit, which will go to the profit and loss account, this would be maybe the additional 8 into what is the useful life of this plant. The question, I guess, tells you that the remaining useful life is around 40 years. So this is into 1 by 40, 8 into 1 by 40 into, for example, 6 by 12, the first 6 months. So 8 divided by 40.2 into 6 by 12. This comes to, I guess, 0.1. So depreciation to, let us say, plant, which is coming at 0.1. So this should ideally be your journal entries. Pass your entries in the books of mini as per 103. This should be the entries. Determine whether any adjustment is required in case valuation received subsequent to acquisition. Yes, adjustment is required. Pass the necessary entries in the books of mini. Well, I guess we have done that as well. These are the entries for the subsequent adjustment. These are the entries for the subsequent adjustment, and this was the entry as per Ind AS 103 at the date of acquisition. Now you have been given the balance sheet of Mini Limited as on 31st March 20x1. In this, ideally you will incorporate your assets and liabilities. So PP will increase ideally by 46.9 on 1st April. So if I had to prepare the balance sheet on which date? Well, as per 1st April, before any restatement, as per 1st April 20x1, you will increase this by 46.9. Apart from that, there would be a goodwill and there would be another license, goodwill and license. So basically, goodwill would be 20 plus license would be 5, and hence this would be 25 separately. There is nothing else in terms of the deferred tax assets, it remains the same. Other non-current assets will increase by 11.1. Inventories remains the same, everything else remains the same, but in cash, I guess you will have to pay 51, which is a purchase consideration. Cash and bank, whatever it is, you will pay 51. You are not issuing any shares, nothing is going in the reserves as such. In the non-current liabilities, within financial liabilities, around 32 worth of financial liabilities. So if we go to see, your PP would be 2158 plus 46.9, which is 2204.9. There would be 25 worth of other intangible assets. Everything else continues to remain the same. 25 plus 11.1. Obviously, we don't need a calculator here. I'm just acting plain lazy. Other than that, everything else remains the same. This is what 12 for CWIP, deferred tax asset is at 324, 368 for inventory, 45, 762, 110 minus 51, 59, then you have 28, 267, and that will give you the total assets. 295 for the share capital, nothing going in the reserve. 717, 2481, there is nothing in the non-controlling interest as well. This is what 268 and 32. I think we see a round number that gives us confidence. 300, 302 and 36. So ideally that will give us a total in the balance sheet before adjustments. We'll see what is to be done if required after the adjustments. 204.9 plus 25 plus 12 plus 324 plus 36.1 plus 368 plus 45 plus 762 plus 59 plus 28 plus 267 comes to 4131, 295, 717, 2481, 300, 302 and 36, 4131. God bless you. You get the total tallied balance sheet over here. Let us just verify what the institute has done, just to be doubly sure of the treatment. So if you go to see the balance sheet, 4131, it kind of ties up at 4131, 4131. Now in case you had to make balance sheet subsequently as on 30th September, yes, you would also consider the additional depreciation. If you want to find a restated balance sheet, let us say in the next year, when you show a comparison, in the comparison your goodwill will appear only at 12 rupees and your property, plant and equipment will have a 54.9 adjustment. So that will be in case you are preparing 31st March 2012 balance sheet and then you are showing a comparison on 1st April 2011 balance sheet. Okay, so that takes care of question number 1. Next we will go to question number 2. This is on Ind AS 21, foreign exchange on foreign currency translation reserve. When you have statements of a foreign branch or a foreign operation or a foreign subsidiary, you need to convert all assets, all liabilities, whether it is monetary or non-monetary, at the closing rate. Remember, we are always of the impression that monetary items at the closing rate, non-monetary at either the historic or the rate on the date of fair value. That is to be the case in case you are doing a foreign currency transaction directly, which is going to be settled ultimately and you are going to receive the currency. In case of a foreign currency translation, we don't have to do any of these. In case of a foreign currency translation, all assets, all liabilities, whether monetary or non-monetary. The objective over here is to prepare your consolidated balance sheet in the parent's currency. So you will convert all assets and all liabilities at the closing rate. The only thing you have to be careful of is equity items. Within equity items, the equity share capital will go at the historic rate, whereas your reserves will be based usually on an average rate. Again, average rate depends year by year. So in the first year, the average rate for the year, let's say 21-22 would be taken, then the average rate for the year 22-23 for the corresponding profits. Keeping that into consideration, we will go to question number 2. This is similar to a question which we have for Ind AS 21, but there you have just position in 1 year. Here you have 2-year positions and a few more adjustments, especially in items like retained earnings. So let us get started with that. Now, Infotech Global, a standalone entity, as a functional currency of USD, and needs to translate its financial statements for presentation currency, that is INR. Okay, so USD to INR. Following is a draft financial statements of Infotech Global prepared in accordance with the functional currency. So you have 31st March 20x3 and 31st March 20x2. So you have the closing first and opening later. And you have the statement of profit and loss as well. You have been given all the data, ultimately coming down to the profit. So this profit, as you can see, goes over here as well. This is profit for the current year. Retained earnings at the beginning of the year. So maybe this must be on 1st April 20x2. Profit for the year, this is 20x2 dash 20x3. Dividends, and then you have the closing retained earnings. Share capital was issued when the exchange rate was rupees 70. So share capital will be converted at the 70 rate. So share capital in either cases will be converted at the rate of 70. irrespective of which year. Let's say if there are 2 years, this is 70, this will also be converted at 70. Retained earnings on 1st April 20x1. Okay, so this is before, this is 1st April 20x2. Retained earnings on 1st April 20x1 was INR 4 lakhs. So if we go to the second question, let us say if we had to find the retained earnings as on date, it is the sum total of all the retained earnings that have happened. So if I look at retained earnings, this is based on 1st April 20x1. This is dollar and INR. We're probably not sure what the dollar retained earnings is, but in INR for sure this is 4 lakhs. Fair enough. Next, at 31st March 20x2, the cumulative gain of 4,92,000 has been recognized in the foreign exchange reserve, which is due to translation of entities' statements into INR in the previous year. So this is basically the foreign currency translation reserve or FCTR balance given to you directly. This is for the year, let's say 21-22. Entity paid a dividend of $3,000 when the exchange rate was 73.5. So this is when it is paid. This is 73.5 exchange rate on the date when dividend is paid. Profit for the year 11-12 was USD 8,000, translated at INR 5,72,000. So this is for the year 20x1, 20x2. The profit I think was $8,000, which gets translated into 5,72,000 in rupees. This must be at the average rate prevailing during that period. We have considered that. Profit of the year 20x2 was 14,500, as you can see above, translated at 10,72,985. So this is going to give you basically on 1st April 20x2 the opening balance, whatever it is in dollars. I need to find this in rupees. So this is what, 9,72,000 in INR plus the profits which have been earned during the period 20x2 20x3 is 14,500. This is converted at 10,72,985, 10,72,985, and less dividends. Less the dividends. Dividends over here is 3,000, and you've been told that this is at the rate of 73.5. So this is 3,000 into 73.5. This comes to rupees 2,20,500, and hence we will get the balance in the retained earnings account as on 31st March 20x3, all said and done. So this is 972 plus 1072,985 minus 2,20,500 comes to, I think, 18,24,485. 18,24,485. This is the balance in the retained earnings. Okay, all of this is taken care of. For the sake of simplicity, items of incomes and expenses are translated at the weighted average monthly rate, as there was no significant exchange rate fluctuation during the entire year and the business of the entity is not cyclical in nature. That's fine. They must have converted at the average rate. We have been given the rupee values actually. The relevant exchange rates on 31st March 2022 and 2023 are 73 and 75. Prepare the financial statements of Infotech Global translated from functional currency USD to INR. Now, they have not specifically told you for the year 2021-22 or 22-23. ICI has converted both of them. You can also convert both of them. It is fairly easy, to be honest. So over here, if you go to see, the only problem arises when you have to convert share capital and reserves. Retained earnings we have kind of found. So basically, what should be your retained earnings? If you go to see, just a second, we take 70 for share capital. Everything else, if you go to see over here, you will take 73 for 31st March 20x2 and you will take 75 for 31st March 20x3. For everything else, retained earnings we have calculated. In the current section, this comes to 18,24,485, and earlier this was around 9,72,000. Share capital, if you convert 50,000 into 70, this comes to around 35 lakhs. So this comes to, I guess, 35 lakhs. Everything else, I mean, to be honest, I'm just doing it slightly faster. This entire 1,51,000 of assets will be converted at 73. So this comes to, I guess, what, 1 crore 10,23,000. You will see a line by line conversion. Obviously, you just have to use your calculators, multiplied by 73. 1,66,500 will be multiplied by 75. So this entire term will be multiplied by 75. So this is around 1 crore 24,87,500. Next, you have payables and loan. This is around 87,000. 87,000 into 75 comes to around, again for both of these, 65, 25 and 38 plus 45 into 75 comes to what? 62,25,000. Now, if I look at the balancing figures of FCTR, so over here, ideally the FCTR has been given, but nevertheless, 1 crore 10,23,000 minus 35 lakhs minus 972 minus 6225 comes to what? No, just a second, have I taken this correctly? 38 plus 45 into 73, this is what? 60,59,000, sorry, 60,59,000, 972, 35 and 1 crore 10,23. This is 4,92,000 as we expected. This is 4,92,000. In fact, this was given FCTR, foreign currency translation reserve, appearing on the credit side as a part of other comprehensive income, reclassifiable OCI. Then you have, I guess, just a second, 87 into, have I done 75? Yes. So this is 1 crore 24,87,500 minus 35 lakhs minus 1824 485 minus 6525. And if I'm not wrong, this is 6,38,015. Better to check it once. And hence during the year, there is an increase of 1,46,015, which should ideally go to FCTR in OCI. Again, it is best if I kind of cross check the numbers once. So, over here, I think 1824 485. I don't actually remember the numbers, unfortunately. Nevertheless, let me just see if my FCTR balance is matching. 146,015, perfect. If this is matching, hopefully everything else is going in line. So the exchange difference is 6,38,000 minus 4,92,000. So during the year, there would be a 1,46,015 adjustment on the FCTR. Okay, so you can just review this entire working. You have the statement of changes in equity and the presentations and the entire workings given. I'm just trying to explain you the broad contours of the question. You can just review it once you have managed to revise it. So that takes care, I guess, of question number 2. Next, we go to question number 3. In my opinion, this is something which you would have definitely done. I think this was in your study material, Airtel infrastructure and Airtel telecommunications. It was an upstream transaction. We'll quickly review this and then go to question number 4, which is a very intense question, I would say. Let us first go to question number 3, quickly wrap this up and then go to the next section. Entity A owns all the share capital of entity B. So A is a parent, B is a subsidiary. On 1st April 2022, A acquired a building from B. So A is acquiring from B. So it's an upstream transaction. Building means it's an upstream property, plant and equipment transaction for 600 lakhs that the group plans to use as its new head office. Entity B had purchased a building from a third party on 1st April 20x1 for 525 lakhs. At the same time, the building was assessed to have a useful life of 21 years and a residual value of nil. Okay, this was purchased on 1st April 20x1 with 21 years of life. On 1st April 20x2, the carrying value of the building was 500 lakhs. Even if this was not given, we could have found this 525 minus 0 upon 21. If you do 525 upon 21, you should be getting 25 worth of depreciation. 525 minus 25 and 500 would be the carrying value. But this is sold at what? Well, this is sold at 600, and as a result, there would be 100 lakhs gain on sale by B to A. But this is in standalone books, you can recognize that gain. However, in consolidation, this gain needs to be eliminated. B's individual financial statements the estimated remaining life of the building from 1st April 20x2 is 20 years, which is logical. 21 years, 1 year has gone by, so it is 20 more years remaining, and the residual value is still nil. The method of depreciation is straight line. Pass the necessary journal entries in recording for the above transactions in the books of entity B, entity A, as well as the group's general ledger. So when I look at entity B, I'll just kind of discuss these entries in the books of B, who has acquired this building on 1st April 2020 x0. Your entry will be building account debit 525 to bank 525, then depreciation entry, depreciation account debit 25 to building, let us say 25, and then the sale entry, bank account debit 600 to building, 500 to profit on sale. This will be 100, and that's it. There will be no further entries in the SFS of B. In the SFS of A, you will acquire the building for the first time on 1st April 20x1, and hence the entry will be building account debit 600 to bank 600. Well, the carrying value might be 400, 500, it does not really matter. In the SFS, I'm paying 600, so building account debit 600 to bank 600. And then for every subsequent year, the depreciation will be 600 divided by 20, that means 30 per annum. So depreciation account debit to building, this will be 30. Now, in the group's ledger, you will have to eliminate the unrealized profit. The profit is recorded in the books of B, and hence you will reverse the profit from the books of B. So the profit and loss of B will be debited, let us say, by 100 to building, which will be credited by 100. So adjusting entry will be passed on 1st of April 20x1. Profit and loss, let us say loosely speaking, of B, account debit 100 to building 100. So that brings the building down in the group accounts down to 500. Now ideally depreciation based on 500 would be 500 divided by 20, that will come to 25. However, you have recorded depreciation of 30 in the books of A, and as a result depreciation will have to be reversed. Now depreciation is an expense. If you reverse it, you will have to credit the PNL. So the PNL of A will be credited in each year by 5 rupees. 30 minus 25, that is the difference of 5. PNL of A will be credited by 5, and correspondingly the building would be debited by 5. So what that will result is, actually in the books of A, you will show 600 minus 30 in the first year. For example, this is at 570. However, from this 570, unrealized profit of 100 was eliminated, and hence the answer comes to 470. However, then 5 rupees of depreciation will be added back, and as a result your net effect will be 475, which is nothing but 500 minus 25 of depreciation for the group as a whole. So this is regarding question number 3. You can refer, I think, question number 7 or so in our books for Airtel Tele and Airtel Infra question, and it is also there in the comprehensive questions in your ICAI SM as well. So nothing really significant over here. Now comes the elephant in the room. Now this is a question which will kind of pose certain hurdles for you when you are revising it. So this institute has taken directly from the Diploma IFRS, DIP IFRS papers that ACCA sets. This is typically a 25 mark question that ACCA has, and they've kind of even picked up the solution directly from that, and you can refer any of the past ACCA, most of the past DIP IFRS questions, exams do have this 25 mark consolidation question, which they do in a particular way. Institute has taken that same solution. You can refer the solution, there's nothing wrong. In fact, it is very logical, that solution. However, that is not very consistent with the other methods that are done. So this is very typical Diploma IFRS. It is actually the DIP IFRS exam question of 25 marks, which has been given to you. You will find it a little tricky. I will solve this in a slightly different way, the way that we usually are used to doing, and hence the solution, the method would be slightly different, though the final answers would exactly be the same. You are free to select whichever method you want. In fact, the institute's method is slightly shorter, more logical, but then you can't have 5 different methods in 5 different consolidation questions. You'll have to follow one uniform method. So depending on, I mean, if you have studied from me, then I have a standard method. We will be solving using that. If you have taken from some other professor, maybe they have a different method. You try to align it with the method that you are doing. Otherwise, you can refer to the adjustments that have been done by the ICAI separately as well. With that, we'll read this question, and again a request to you, if possible, you can just pause the video or separately read and understand the terms, contours of the question before you proceed, because it's a fairly intense question. Let's go and mark this as the most important question that comes from the RTP. Okay, let us read this. Issuer Limited holds investments in Vinayak Limited. The draft balance sheet of the two entities on 31st March 20x4. Significance on the dates 31st March 20x4 is as follows. Okay, so you have property, plant and equipment. All of this is given in rupees thousands, but most of the adjustments that you will see in this question will come in rupees million. So Current assets comprise of inventories, trade receivables, cash and cash equivalent, share capital, retained earnings, other components of equity, provisions, long-term borrowing, deferred tax, trade payables, short-term borrowings, standard adjustments. Additional information, issuer's investment in Vinayak. Now there are 3 or 4 adjustments that we will discuss over here. Now the standard steps involved. In step number 1, you prepare the schedule 3 format of the balance sheet. Step number 2, you prepare the notes to accounts, and in step number 3, you go for the working notes. I will start from step number 3 directly. Step number 1, you should ideally prepare the schedule 3 format. I think in the interest of time, I think that is understandable. Step number 2 is notes on assets and liabilities. I'll take this as a proxy. I'll take this entire table as if these are notes to accounts, and then we go to the 3 all important notes: the consolidated other equity note, the goodwill calculation, as well as non-controlling interest, and then the analysis of other equity items. So let us refer that. Additional information. Well, issuer's investment in Vinayak on 1st April 20X1, issuer invested. See, the balance sheets that are given to you as on 31st March 20X4. So that is basically, I guess, 3 years from the date of acquisition, and the acquisition has happened on 1st April 20X1. Issuer acquired 400 million shares of Vinayak by means of a share exchange. So they have acquired 400 million. Now how many shares are there in Vinayak? So this is 500,000. Remember, in million, that is, this would be 500 million. So basically the stake that you have is 400 out of 500, and that is an 80% stake, and hence 20% is attributable to NCI. By means of a share exchange of 1 share in issuer for every 2 shares acquired in Vinayak. On 1st April 20X1, the market value of each share of issuer, remember issuer is the acquirer, was ₹7. So basically this will help you in calculating the purchase consideration. So basically your PC, or basically now that you are 2 or 3 years down, the investment amount should ideally be 400 into 1/2. So for 400 shares, we are issuing 200 shares of issuer, and each share of issuer is worth 7, and hence 1400. Remember, this is in million. 1400 in million would be your investment amount. Issuer appointed a professional firm for conducting due diligence for acquisition of Vinayak, the cost of which amounted to 15 million. Okay, ideally this cost has to go to the P&L account as per Ind AS 103. Issuer included these acquisition costs in the carrying amount of the investment in Vinayak in the draft balance sheet of issuer. So basically what issuer has done is, to this 1400 they have added, and hence this is appearing at 1415, which is wrong. So there has to be an adjusting entry that has to be passed, which is your profit and loss account of issuer account debit to your profit and loss of issuer account debit to investment. Your investment has to be reduced by 15, and your revised investment should be at 1400. There has been no change to the carrying value of this investment in the own balance sheet as on 1st April 20X1. So basically when we typically prepare, so when you look at question number 4, you first prepare the schedule 3 format of the balance sheet, then you prepare the notes to accounts. In the interest of time, I will do this directly based on the data in the question. Next, you prepare the 3 all important working notes. So your working note number 1 is usually consolidated other equity. You will usually write down all the other equity items. This is given in thousands, so this is retained earnings as well as other components of equity. So maybe this is RE, I'm just writing this in short, and other equity. We usually start with standalone parent. So this is standalone. Issuer, I'm just writing this in short. So over here, Issuer standalone would be 2865 and 1250, 2865 and 1250. I could have referred the solutions directly, but because consolidation is so much process driven, I want to kind of maybe spend some more time and do it together. So this is, maybe you leave around 8 to 10 lines, and then you have working note number 2. This is on the goodwill workings. If nothing is given, goodwill is to be calculated using proportionate net assets method. That is partial goodwill if NCI is using proportionate net assets. As we read the question further, you will see that. Ideally, we should read the question and then come to that conclusion. So over here, this is rupees and rupees. You typically start with the investment amount. Now, while doing so, your investment amount should ideally be calculated. Your investment amount should ideally be calculated as 1400 as we have done. Now your investment, this is 1400 in millions, so if you multiply this 1400 into 1000, that comes to what, 14, I think, what, 14 lakhs. They have recorded this as 14 lakh 15, and hence there would be an adjusting entry. You don't have to pass any entries, but I'm just giving this to you for your reference. You will have to adjust that 15 which is wrongly recorded as a part of investment. So your adjusting entry would be, let us say, P&L of issuer account debit 15 million, so 15 into 1000 I guess will be 15,000, to investment 15,000. So your investment which is appearing in your books at probably, if I show the calculations, or we have just shown that separately, let's say it is appearing at 1415, we subtract 15 and then you multiply this by 1000, so this is rupees 1000, everything is rupees 1000, and as a result, in short, this would appear at 14 lakhs. Investment will reduce by 15 and at the same time minus, let us say, acquisition cost as per Ind AS 103, which has to go to the profit and loss account, will go to the profit and loss account over here. So that 15,000 is kind of managed. For goodwill calculation, you should take the correct PC, which is 1400. Fair enough. On 1st April 20X1, the individual statements showed a balance of retained earnings 750 and other components at 25. So usually what we do over here is we take share. There can be multiple answers. You can always add NCI and then subtract the entire net worth, or you can take investment and less the share of the net worth. Let's say we take share of net worth. We take the share of net worth on 1st April 20X1. This is the acquisition date. Maybe leave around 10 lines, and then working note number 3 should be, we don't have enough space, so maybe working note 3, which would be non-controlling interest. Your NCI is 20% calculated using proportionate net assets. We will see this as we progress further in the question. So net worth, we want to back calculate the net worth as on the acquisition date. This is equity share capital. This is 80% of 500. Well, that comes to 400 in thousands. That will be, I guess, what, 4 lakhs. I better to cross check. So this is 4 lakhs, and NCI also has a share in the share capital, that is 20%, which comes to probably 1 lakh. So your equity share capital of Vinayak, which was missing, has been taken care of. Now when you want to proceed further, you have to have a working note number 4, the all important analysis of other equity items. You can do this separately for retained earnings and for other equity items. So let us say our standard format entails you having a particulars, then your total, okay, then you have 2 items, so you'll have retained earnings, within which you have total, then the pre and the post, and then you also have other equity. You don't have a lot of items in other equity, so we can have a slightly other components of equity, a slightly narrower column, total, pre and post. Now in this, how do you start? Well, we start based on the balances given in the question. So you'll have the balance on 1st April 20X1. This is necessarily going to be pre plus the profits that you must have earned in the 3-year time frame from 1st April 20X1 to probably 31st March 20X4, and subtract dividends if any have been paid, and this will ultimately give you the balance on 31st March 20X2. We have to be careful not to make any mistake over here. Everything is given in rupees thousands. Beyond this, there would be a lot of adjustments that will have to be given effect to. So based on the data given, you have the balances as 10 lakh 50 and 50,000. So the closing balances, as we see over here, would be 10 lakh 50 for the retained earnings. Opening balance as on the date of acquisition, on the same page you see at the bottom, this is 7.5 million, 7.5 million, I guess, 750 million, 750 into 1000 comes to 7 lakh 50. Similarly, the closing over here is 50,000, and you see, I guess, a 25 million. So 25 would give you 25,000. Now, going further, again, I would request you to read this humongous question, because again, we don't want to spend a lot of time just reading this question and then getting lost. So if you have not read, just pause the video and read the question once. We are just discussing the adjustments as well as the application side by side in the interest of time. So over here, if you read the question further, you will find that there is no further dividend, and hence a balancing figure over here would be the profits, which will be 3 lakhs, which will be a 25,000 increase as well. Now 7,50,000 is entirely pre, nothing of this is post, because this was existing as on the date of acquisition. In a similar fashion, 25,000 is entirely pre, nothing of this is post. 3 lakhs has been earned in the next 3 years, and hence this is entirely post, nothing of this is pre, and similarly 25,000 is entirely post. So you've managed to analyze the profits over here, coming to 7,50,000, coming to 3 lakhs, coming to 25,000 and 25,000, and beyond this comes our adjustment step. So all further adjustments based on the data given in the question will be made beyond this, for which if required we will also be passing the journal entries. So this kind of takes care of all the impacts of the adjustment that is there in the first sub point. So this is considered. Next, the directors of issuer carried out a fair value exercise to measure the identifiable assets and liabilities as on 1st April 20X1, and the following matters emerge. Remember, this is something which is a fair value adjustment as on the date of acquisition. Institute has solved this using the net assets method, which is possible, which is logical, but that is not something that they have done in any other question in their study material, and hence we try to keep the method consistent to what is done, so that you are at least able to apply that. If you want to see the institute's method, you can see that our answers will be exactly the same to the last decimal. Okay, so let us see the fair value adjustments. Do you want to pass the entries? Well, it is optional. You do not need to pass the entry, but in case you want to do, so you will have fair value adjustments or all types of adjustments as a case may be. Institute never passes entry. We also don't mandatorily require you to pass the entry. However, if you want to kind of get the double entry very clear, it is best if you kind of do so. So property having a carrying amount of 800 million, that is land of 350 and buildings of 450, had an estimated fair value of 1000. So the overall fair value increases by 200. Land component is 400 and building component is 600. So basically land goes up from 350 to 400, that is a 50 increase. The building goes up from 450 to 600, that's a 150 increase. The building component of the property had an estimated life of 30 years as on 1st April 20X1, and hence that will result in additional depreciation. So if I look at the adjustments, there can be certain initial as well as certain subsequent adjustments. So initial adjustments will pass it through a single entry. So this will be your land, which is going up from 350 to 400. Let us say we first look at this in million, and then we can incorporate the 1000. So this is 50. Building again in million, which comes to I think 600 minus 450, and hence this comes to 150. Remember, building has depreciation, land does not have depreciation, and this is depreciation for a 3-year time frame, and hence there will be a post acquisition retained earnings or P&L impact for the additional depreciation account debit to, let us say, the buildings. What is a building component? Well, the building component is an additional 150, which is to be depreciated over 30 years, out of which 3 years have gone by. Sir, how did you calculate 3 years? 1st April 20X1 to 31st March 20X4, that is 3 years. So 150 divided by 30 into 3, that comes to 15 in million. Okay, so that fully incorporates the effect of the first adjustment. When you look at the second adjustment, plant and equipment having a carrying amount of 600 had an estimated fair value of 700, which means the plant is going up by, let us say, 100. The estimated remaining life of this plant on 1st April was 4 years. None of the plant had been disposed of between this time frame. Perfect. So you'll have the same entry. Plant debit, this time around 700 minus 600, which comes to 100. So your plant is debited by 100. Again, there would be certain additional depreciation attributable to plant, which is, let us say, 100 to be depreciated over 4 years, out of which 3 years have gone by, and as a result this will probably come down to 75, and hence in the post acquisition period your post return earnings will be debited by 90 due to the total impact. We will give the two effects for all of these together. On 1st April 20x1, the notes to financial statements of Vinayak disclosed a contingent liability. Fair enough, that is just a disclosure. On 1st April, the fair value of this liability was reliably measured at 30. Remember, Ind AS 10 teaches you that you will take over the assets and liabilities at fair value, even if they're just given as disclosure in the notes to accounts. So you will take this over at 30. The contingency was resolved in the year ended 31st March 20x2, and no payments were required to be made in respect of this liability. But as on the date of acquisition, there was a liability. So maybe if you leave a couple of lines to, let us say, liability, there is some liability whose fair value is 30. Okay. Subsequently, if this liability was to be paid, then in the SFS you have just given a disclosure. If this was to be paid, then in the SFS you must have passed the entry P&L account debit to bank, and hence there would be a loss in the SFS, but in the CFS your entry would be liability account debit 30 to bank 30, so there would be no further post acquisition loss. However, since there was nothing to be paid, then in the SFS there would be no entry pass, because in the SFS of Vinayak you did not recognize a liability, and hence if that need not be paid, there was no question of reversal, so there was nothing passed. But in the CFS, ideally the liability was recorded, which is no longer there, and this is happening after the acquisition date, and hence the liability will be debited, but then what will be credited? The post acquisition P&L or the retained earnings. So over here there would be a separate entry for liability debit, let us say 30, to the post acquisition retained earnings. We have discussed this in the earlier theory when you must have done fair value adjustments on subsequent treatments. So this takes care of sub point 3. Now comes the real problem. Fair value adjustments have not been reflected in the individual statements of Vinayak. This was implied. And in the consolidated statements, the fair value adjustments will be regarded as temporary differences for the purpose of computing deferred tax. Okay, so whatever is the fair value adjustments, you will have to calculate a net deferred tax impact. The rate of deferred tax to apply to the temporary difference is 20%, and hence there will be a deferred tax adjustment. Now this creates a bit of a hurdle. So there would be deferred tax adjustment on 1st April 20x1. Now this is on net assets. Net assets. Now as per carrying value, if I go to see the carrying value of net assets, obviously I can actually try to find the total carrying value of net assets and their fair values. So if I try to calculate the carrying value, this will be based on the fair value. Compare this with the tax base, which will be based on the book value. So the fair value of the land on the date of acquisition, I guess, was what? These are all the fair values. These are all the carrying values. So this is basically 400 plus 600 plus 700 plus, when I look at the liability, there would be a minus 30. So for these relevant items, this would be 400 plus 600 plus 700 minus 30. So this comes to, I think, 1670. When I look at the tax base, I will take their old carrying values, that is 350 plus 450 plus 600 minus 0, because there is just a disclosure, and as a result this is 350 plus 450 plus 600, just a second, 350 plus 450 plus 600 minus 0, this is 1400. So this is 1400, and hence there is a difference. There's a difference to the tune of minus 1670. There's a difference of 270. As you can see, the difference is 270. This is a difference where the carrying value, that is a value as per Ind AS, is greater than the tax base. And when this happens, remember the answer is opposite as per the rules that we studied for deferred tax liabilities. There will be a DTL at the rate of 20%, that is 270 into 20%, I guess this comes to 54 of deferred tax liability as on the date of acquisition. Remember, over here the value as per Ind AS is greater of a net asset, and hence you will get a greater write-off in the books in the future years, which means you will get a lower deduction in income tax in the future years, and hence that results in higher tax payments and hence a liability as per income tax. This is 54. So this is 2 DTL. You can have other alternative ways in which you can get this answer, but having said that, 54 over here is a reasonable value. So this will give you the deferred tax impact on 1st April 20x1. Mind you, there will also be a deferred tax impact when you prepare the final ultimate balance sheet, but as of now this will be 54. 2, let us say you will have the pre-acquisition retained earnings. Remember, this is fair value adjustment which we adjust against the pre-acquisition retained earnings. This is what? If I calculate, I guess this comes to 216. This will come to 216. Better to verify this once. Let us say 300 minus 30 minus 54. Yes, 216. Now these net assets will also have some impact. So this is on 31st of March 20x4. What will be the position? Carrying value. This will be the fair value of those net assets. Let us say this is 400 minus a 0 depreciation plus, let us say, okay, or this might get a little tricky, this might get a little long. We'll try to do this by a slightly alternative method. We can just directly find the impact due to these depreciations directly, though having said that, you can actually try to find the values separately as well. Let us just try, let's finish this off. Carrying value, which is basically the fair value over here. So this is 400, this was for land, there would be no difference. When I look at building on the other hand, there would be 600 minus 600 upon the useful life, I guess, was how much? 30 years, out of which 3 years have gone by, plus there was plant was 700 minus 700 upon 4 years, out of which 3 years have gone by, and there is no further contingent liability, and hence that will be 0. Apart from that, if I want to find the tax base, this is as per income tax. As per income tax, you will continue this at 350 plus you will have 450 minus 450 upon, again as per income tax, 30 into 3 plus in the income tax for plant 600 minus 600 upon 4 into 3 plus in income tax as well, there would be no further liability. So if you take this, it should kind of get sorted. So if I look at 600 and this is 600 divided by 30 into 3, this is 60, and hence this is 540 for the building, 700 divided by 4 into 3, and you have 700. This is okay, so total is 715 and 400. If you just do this mathematical operation, ideally your Ind AS value will be 1115. 1115 should be your Ind AS value. As per income tax, this will be what? 450 600 350. I guess this is 905. Again, this is a possibility where there is a difference. The difference, I'll just try to reconcile the difference. I understand this is a little intimidating, but this is 1115 minus 905. So the difference is now 210. Earlier the difference was 270. So the difference has reduced. Again, this is a possibility where carrying value is greater than the tax base, and hence this will still be a DTL at the rate of 20%. So this is what? 210 into 20% will come to, I guess, 42. However, there's a DTL in your books already at 54, which if it has to come down to 42, there has to be a reduction in DTL. There has to be a reduction in the deferred tax liability. Now, why is this reduction happening? Why is this difference reducing? So your entry, adjusting entry over here would be, you have already created a DTL at 54. Now it has to come down to probably 42, and hence there has to be a reversal entry that comes to the tune of, I guess, 12 rupees. Now, just to reconcile, why should the difference reverse? The difference reverses due to depreciation. Earlier the difference was created. Now the depreciation, additional depreciation as you go to see is 15. Then additional depreciation as you go to see is 75. So there would be an asset which had a 90 rupee difference which was reversed. So for assets you had a difference of what? 50 plus 150 plus 100. That is a 300 difference, out of which in the form of depreciation 90 of difference has already been reversed. Apart from that, there was a liability which there was a difference of 30, and now the difference of 30 has been reversed. So if the difference of 30 has been reversed for a liability, which means the net difference that is reversed for an asset which is 90, for a liability which is 30, so the net difference which is reversed, I guess, is 60 rupees. And 60 into 20% if you go to see is 12. So it's a fairly tricky discussion, but if you have a fairly good grip of Ind AS 12, you can just rewind back and try to come to the conclusion. Remember, there's an asset whose differences have reversed by 90. So the carrying value is greater than the tax base, but now that differences have been reversed by 90 due to higher depreciation in the books as compared to income tax. Similarly, there was a liability which in books was greater as compared to income tax, and that has been reversed because there's now no liability in the books, no liability in income tax. So when a liability reverses versus an asset reverses, they have an opposite impact, and hence 90 minus 30, that is 60, and 60 into 20%, that is a net reduction of the net deferred tax liability by 12. So your adjusting entry, so let me just put this over here. Therefore, there would be an adjusting entry even that is passed on 31st March 20x4. This would be DTL debit. So DTL first has to be credited. Yes, it has credited by 54, but now this DTL has to appear at, for example, 42. So DTL will be debited. DTL will be debited by 12. How did we get 12? Well, 54 minus 42, that is 12, to, let us say, post-acquisition return earnings. This will go in the post-acquisition return earnings to the tune of 12. So these are the impacts that will go, for which now we have to give the necessary postings. So if I were to give the necessary postings for this one entry, 0.1, second entry, 0.2, third entry, 0.3, fourth entry, 0.4, then I will properly give effect to all of these adjustments. The directors of Ishwar use the proportion of net assets method while measuring the non-controlling interest in Vinayak on the consolidated balance sheet. So let us try to give these impacts at the right place, again in thousands. So land is increasing by 50 million. Now in thousands, that is, I guess, 50,000. So if I look at the balance sheet over here, I will increase this by 50,000. Then just a second, this is 50 taken. Building is increasing by 1,50,000 plus 150. Planting is increasing by 1 lakh. Achha, then there are liabilities which are, well, to say, let's say other payables, these are increasing to start with at 30,000. And deferred tax liabilities, these are increasing by 54,000. So we have given effect to all of these except for this 216, which will go in fair value adjustment. 216, this is 2,16,000. These are increases which are there as on the date of acquisition, and hence we take this in the pre-column. So we have given effect to this entire entry. Next, you go to the post-acquisition section where the post-return earnings is going down by 90 and 15 and 75. So basically, if we go to the PP again, this is minus 15,000 for the additional depreciation on the building, minus 75,000 for the additional depreciation on the plant. So this will take care of these as and then post-return earnings, this will be for additional depreciation. So this is additional depreciation. This will go in the post section. This is I think 75. I'll just combine this, 75 and 15. This is 90, and let us say this is 90 over here, which is reduced. Okay. Next, you have liabilities 30 to post return earnings 30. So this is liabilities. We will just reduce the liability. You added by 30. Now we'll subtract it by 30. So the effect is not appearing in the final balance sheet. And to post P&L. So this is, let us say, liability kind of waived off. We thought that there was a liability in the SFS. There was no liability, it was just a disclosure, but in CFS there was a liability which is not to be paid. So this is 30,000 for the same. And then there would be some deferred tax impact as well. There is DTL of 12 to post return earnings. So there will be post return earnings. So this is post deferred tax adjustment. Now return post P&L over here is credited, and hence this will 12,000 increase. So this is a 12,000 increase. Secondly, in the deferred tax, you are decreasing 54,000 liability decreases, let us say, by 12,000. Go back, revise this. It is not going to flow very naturally in your mind. Obviously, there can be different methods. You can use it, the institute method as well. It will give you ultimately, as you will see, the same final answer. Okay. Impairment review of goodwill on acquisition of Vinayak. So this is impairment review on acquisition. Okay. No impairment of goodwill of Vinayak was evident when the reviews were carried out on 31st March 12 or 13. But on 31st March 14, the directors of Ishwar carried out a further review and concluded the recoverable amount of the net assets of Vinayak as on that date was 2,000 million. Okay, so this is recoverable value. Vinayak is regarded as a single cash generating unit for the purpose of measuring goodwill impairment. So we have to see whether the goodwill is impaired or not, for which we need to do we need to see whether goodwill is calculated using the partial goodwill method or the full goodwill method, because if it is calculated using partial goodwill method, which is the case over here, the grossing of provisions as per the appendix to Ind AS 36 will apply. In your study material questions, at least for consolidation, usually the impairment amount is directly given. However, whenever you have to compare the recoverable value with the carrying value, remember the recoverable value is for the entire business of Vinayak. We are taking over 100% of the assets and liabilities of Vinayak. That is perfect. However, beyond 100% of the assets and liabilities of Vinayak, you are also having goodwill of Vinayak, but you are recording only 80% of the goodwill, and as a result, you will have to gross up the goodwill. If you remember, as per Ind AS 36 provisions, you will have to gross up the goodwill, then recognize impairment, and hence a separate working will have to be done over here for the same. So we'll have to first calculate the goodwill, see if there are any further adjustments, try to find the goodwill, and then go ahead and do the impairment workings. So over here, this would be pending because we first need to find goodwill, and we first need to see if there are any further adjustments which impact the goodwill. Now there is one more adjustment over here, which is on provisions. On 1st April 20X3, Ishwar Limited. Now this is a parent. Till now, everything was for Vinayak. Now you are in Ishwar's book. Ishwar completed the construction of a non-current asset with an estimated useful life of 20 years. Okay, this is what Ishwar has completed. The cost of construction were recognized in the property, plant and equipment and depreciated appropriately, which is perfect. So whatever is the cost of constructing that equipment was recorded, and correct depreciation has been charged. Ishwar has a legal obligation to restore the site on which the non-current asset is located on 31st March 20X43. So that's quite a long time in the future. We are now on 1st April 20X3, and now you are going into 43. So that's, I guess, X number of years away. The estimated cost of this restoration work on 31st March 2043 is 125 million, and directors have made a provision of 6.25 million. The directors have made a provision of 6.25 million, that is 1/20 into 125 in the draft balance sheet on 31st March 20X4. Now what have the directors done? The directors, it seems, at least what the institute has taken, have created a provision. It is not mentioned that this provision is created against the asset, and hence probably PP is not impacted. They have taken this against the P&L. That is what the institute has assumed. An alternative assumption is very much possible, but they have said that, well, the cost of construction have been correctly capitalized, but this is not construction cost, this is dismantling cost. Dismantling cost has not been capitalized. The question tells you that you have created a provision. First, the provision is calculated in a wrong way. Maybe it is 20 years later that you are going to do dismantling. You do not directly recognize it at 125 upon 1/20. No, that is not how it happens. In fact, you recognize it at present value basis, and you don't debit the P&L, you actually debit the PP. And hence there will be a few rectification adjustments that are required. However, all of these adjustments will happen in Ishwar's books, and hence it will not impact Vinayak's. Paise, so basically 31.2 paise is rupees 0.312. Prepare the consolidated balance sheet of Ishwar as on 31st March 2014. Consider deferred tax implications. So over here, before we kind of total up, we'll just try to pass entries for adjustments for provisions. Now these are adjustments in issuer's books, and hence it will largely impact working note number 1. It is not going to impact working note 2, 3 or even 4 in my opinion, but let us just try to review it. Now ideally on 1st April 20x3, what is the correct entry that you should be passing? Your correct entry that you should pass is PP account debit. Again, you don't have to show these rectification workings, it is just so that you get more clarity. I'm just doing that. So this is PP account debit to, let us say, provisions. Now by what value will you create the provision? Well, this is going to be 125 into the present value factor at the rate of, I think, 6% for the 20th year, which is given to you as 0.312, and hence 125 into 0.312 will come to 39. Again, this is in millions, so this is 39. What is the wrong entry? Remember, you have recorded a provision, so basically it seems that your wrong entry is P&L of issuer account debit to a provision which is created at 6.25, and hence your provision has to be adjusted. Now if you go to see going forward, what would happen? The correct entries on 31st March 20x4 would involve the PP getting depreciated as well as a provision there is unwinding. So over here there will be finance costs which will go to the P&L of issuer account debit to provision. There would be an unwinding of provisions. This is what? 39 into, I guess, 6% for 1 year. So this is 39 into 6% comes to, I guess, 2.34. Is the rate 6% only? Better to verify. Yes, 39 into 6% comes to 2.34. 2.34 will be the impact. There is no corresponding impact given in issuer for the same, and there would be certain depreciation. So this is P&L again of issuer account debit to PPE. The PP over here would increase by 39. There is a 20-year life. 39 by 20. This is 1.95 to PP. Maybe issuer must have recorded an entry had it capitalized this 6.25. It has not even capitalized as 6.25, and hence there is no further entry. So basically, okay, low power, I think even we are low on battery. So over here the net impacts that we have to create over here would be, if I go to see, your PP should be debited by 39 and then credited by 1.95. Neither of this has happened. So your net impact on the PP account debit 39 minus 1.95, account debit 39 minus 1.95 comes to around 37.05. This is the value at which PP will increase. Provisions, which should increase by 39. However, they have already been increased by 6.25. So the net amount. So leaving a couple of lines to provisions. Your provision, had there been no unwinding as well, should have gone up by, let us say, 39 minus 6.25, that is 32.75. Apart from that, there should be some unwinding as well of 2.34 plus 2.34, which was not considered, plus 2.34, and hence the provision will go up by 35.09. So that is provisions done, and then the next effect is the P&L. So basically in the P&L of issuer there should be 2.34 and there should be 1.95, but what has already gone is 6.25. So over here you will have to, I think, credit the P&L because you have taken a 6.25 expense in the P&L, which you have to reverse. Instead you have to book an expense of 2.34. You have to book an expense of 1.95. So ideally what should have gone in the P&L is 2.34 plus 1.95, which means 4.29, but what has gone in the P&L is actually 6.25, and as a result 1.96. Hopefully the entries will tie up. So if you do 35.09 plus 1.96, and there you go, 37.05. This is your net effect. Again, you don't have to necessarily pass journal entries. They have done this directly. Having said that, this will give you a better understanding of what ultimate effects have to be given. So this is, if you take it in thousands, this is 37.05 into 1000 comes to 37050. So if I prepare the balance sheet, 37050. maybe I'll add the PP of Ishwar over here by 37,050. Second, the provisions have to increase on a net basis 6250. As you can see, this was the provision. So your provision has to go from 6450 to, let's say, it has to increase by 35.09 into 1000, that is 35090 net, all considered 35090. And you have already taken the prepared the P&L of Ishwar. This is going in working note 1. So this is plus adjustments on rectification of site restoration obligation provision. This is, I think, 1.96, that is 1960, and hence consequently we have given all the effects. Remember, it might sound longer, but as long as you kind of give all the effects, you will not get lost in these big questions. So now all the adjustments have been done except for the goodwill impairment adjustment, and now we know that there is nothing else in this question apart from these adjustments for the goodwill working, and as a result you can actually try to calculate goodwill as well. You can give all the adjustments except for the goodwill impairment adjustment. So if we try to total up, let us say we take adjusted balances. Remember, goodwill impairment adjustment will directly go to the consolidated P&L and the goodwill working, so we can just balance these out. There is no intercompany balances. Let's say 10,50,000 plus 2,16,000 minus 90 plus 30 plus 12. This is read as 12,18,000, the adjusted balance, which is analyzed as, I think, 9,66,000 in the pre-section, and I guess 2,52,000 in the post section. Let me just verify whether these numbers are tallying. 12,18,000, thankfully yes. There is no further adjustments. All adjustments we do directly in the retained earnings unless otherwise given. 25 and 25. So what we do is we will analyze. This is attributable to the parent 80%, NCI 20%. So this is 966 into 80% comes to 7,72,800 and 1,93,200. 252 into 80% comes to 2,01,600 and 50,400. 25 into 80, I think it is 20,000 and 5,000. Similarly, 20,000 and 5,000. So the pre-acquisition section over here will go to working note number 2, which is on goodwill. The post-acquisition section will go to working note number 1, which is consolidated reserves, and then everything else will go in the NCI. So this is let us say in goodwill, share in the pre-acquisition retained earnings coming from working note number 4. This is what? 7,72,800. Corresponding to that, in the NCI you will have the pre-acquisition retained earnings. This is what? 193,200. Next you have the pre-acquisition other equity. This was 20,000, and pre-acquisition other equity, this was 5,000. If you now total up, you will ideally get the NCI as on the acquisition date, plus share in post profits. Well, that can be post retained earnings, which is 2,01,600, I guess, and other equity of 20,000. If you go below, you will then have the post retained earnings and post other equity. Post retained earnings are 50,400, 50,400 and 5,000. Perfect. So this kind of takes care of all the adjustments except for the goodwill impairment adjustment. I'm really sorry, I'm out of battery, so I'll just try to wrap up this question if possible, and then we'll resume soon. So over here, this is 5,000 each. Just a second. So if we now total up, in order to find the goodwill, we will keep the consolidated other equity, etc. to be done later, because there can be a goodwill impairment. So this is what I guess 4,772,800 and 20,000. This is 11,92,800. And if I take the difference, this would actually give you the goodwill as on the date of acquisition. This is 1st April 20x1. Whatever method you calculate, net worth method or net assets method, you will get 2,07,200. Now there has been no further impairment of this goodwill. However, there is a possibility that there can be no impairment on 31st March 12 and 13, but there can be a possibility in 31st March 14 or 24, as I guess maybe. Now NCI, will there be a possible change in the NCI? Well, if it was partial goodwill method, no. If it is full goodwill method, yes, there can be a change. In this question, that's a partial goodwill method, and hence there will be, even if there is an impairment on goodwill, it will not really be attributable to NCI, but we will wait for totaling the NCI balance to start with. Now that we have all the possible data, what we can try to do is we can try to find the impairment for goodwill. Now, how do you calculate impairment for goodwill? You treat Vinayak as a whole, as the entire CGU. So the next working note would be to treat Vinayak as a whole as a CGU, as the question mentions, on 31st March 20x4. Multiple ways in which you can do this. You will first have to calculate the carrying value. This is the carrying value as per Ind AS, and then compare it with the recoverable value. While you do that, you will try to find the carrying value of the net assets. You will try to find the carrying value of the net assets based on whatever is the working that you have done for just Vinayak. Now, if you look at Vinayak, there are a lot of adjustments that are there. Now, you can keep on doing the working one by one. Now, that will kind of take time. Alternatively, you have taken a lot of, there are multiple ways in which you can solve again. You can take the total assets. You can take the total assets as appearing in the balance sheet minus the total liabilities of Vinayak as appearing in the balance sheet, and then make certain fair value adjustments if required. So this will be slightly faster if you go to see. So when we look at the total assets, so if you look at the total net assets over here, you will have 26 lakh 15 of total assets. Remember, this is as per the book value. So we will take 26 lakh 15,000, let us say, as per the book value. If you look at the total liabilities come to, let us say, what do we say, 5 lakh 90 and 4 lakh 25. Other 16 lakhs is worth the equity items, and hence this will be 5 lakh 90 plus, I guess, 4 lakh 25. So if we total up these items, you will get what? 590 plus 425 comes to 10 lakh 15,000. Remember, this 10 lakh 15,000 over here will give you the net assets as per book value before any fair value adjustments on acquisition. So this is, let's say, 10 lakh 15 and let us say 26 lakh 15, and this comes to, let us say, 16 lakhs. Could we have found the 16 lakhs? Yes, it was net worth or net assets based on the book value. However, you are trying to do impairment working specially for goodwill, and if you want to do impairment working for goodwill, that is in the CFS, and in the CFS there would be certain fair value adjustments. So there would be certain fair value adjustments at the stage of the CFS. These fair value adjustments will pertain to items like land, building, plant, even liabilities for that matter. So if you go to see land, you had an adjustment of 50,000. There was no further effect of that. So this will appear, let us add 50,000 only. You can refer the journal entries. For building, there was an adjustment of 1,50,000. However, there was an additional 15,000 of depreciation that was also impacted. And hence this was, I think, 1,35,000, the net impact on building over the 3 years. For plant, this was 1 lakh, and there was a good 75,000 adjustment. So I guess this comes to what? I think 25,000, and for liabilities you had increased the liability by 30, but at the end, as of now, there is no further liability, and hence this will be kind of 0. And hence if you look at the fair value adjustments which are there, the fair value adjustments would be 50,000 plus 1,35,000 plus 25, and hence this comes to, I guess, 2,10,000. And if I have to find the net assets, for example, for this line item, let us say at fair value, the net assets after considering all possible fair value adjustments should ideally be 18,10,000 over here. Now, have we missed out something over here? Well, yes, there is also deferred tax adjustment. So there was a DTL which was arising out of this. This is also part of the overall net assets, and hence there will be a deferred tax liability which was originally created at 54,000, and then you subtracted 12,000 which was further removed, and hence the net impact including deferred tax which we take is 42,000. The net deferred tax liability will be 42,000. This has to be subtracted, and hence if I go to see, the question just does not seem to end. The entire question seems, the entire RTP seems to be this question only. So this is, I think, 2,10,000 minus 42,000, and you have 1,68,000. So all the fair value adjustments, again, why are we doing this? And is there another way in which this can be done? In my opinion, yes. In fact, a much more simpler and a faster way. 17,68,000 you have already calculated. Over here, if you go to see, you have already calculated in this working the fair value of 1115. Now, for all the other items, you will add and subtract the book value and 42,000 for deferred tax, and you will get the same answer, because this is based on the fair value of these items as per your books. Otherwise, you can take 17,68,000. Now, this is fair value of net assets. This is 100% of the net assets that are taken over. You are remembering taking over 100% of the net assets. However, this does not include goodwill. Now, the goodwill we have just calculated in working note number 2. This is, remember, partial goodwill. This is to the extent of 80%. So, if you look at goodwill from working note 2, you will get 80% of the goodwill coming from working note number 2, which I guess was 2,07,200. Now, 2,07,200 was 80%. If I want to compare this with the recoverable value, I need to gross up. This is NCI share of goodwill, which is basically unrecorded. However, to compare apples to apples, I need to compare 100% of the business value with 100% of their carrying value and recoverable value. So, if 2,07,200 is for 80%, then for 20% it is how much? I guess this comes to 51,800, and hence the gross goodwill comes to, I guess, 2,59,000. So this is 2,59,000, and hence this is 100% of the goodwill. So a total carrying value for 100% of the business. Why have we done this over here? Because we need to compare this with the carrying value and the recoverable value. So this comes to, I think, 27,000. You will now compare this with the recoverable value, which is, unless given otherwise, for the entire 100% of the business. Now, this recoverable value, if you see in adjustment 2, is given to us 2,000 million. 2,000 million, that is 2,000 into 2,000, that comes to, I guess, 20 lakhs, and hence there would be an impairment. There would be an impairment which will come to, I guess, 27,000. All said and done, 27,000, but this is 100% impairment. Now, where will this impairment be first attributed? The impairment will first be attributed to goodwill and then to other assets. This is impairment testing of goodwill. If I go to see, the goodwill in my ledger is coming. So, this is first going to go to goodwill and then it is going to go to others. Now, this entire 27,000, in my opinion, will entirely go against goodwill, because the goodwill for the overall working is 2,59,000. Now, 27,000 will reduce 2,59,000. However, in your books of accounts, 27,000, remember, comes out of 20,27,000, and in 20,27,000, 2,59,000 is included. And as a result, when we do this working, we will say, okay, well, you know what, 80% of this is attributable to parent, 20% of this is attributable to NCI. So if I look at 27,000 into 80%, this comes to 21,600. This will go against the parent's consolidated PNL, whereas the remaining, if I go to see, around 5,400, remember, this should ideally go against NCI. However, if you have not recorded goodwill attributable to NCI, you cannot record an impairment. You cannot record an impairment on a non-existent item. That 50, so ideally 21,600 should be adjusted against 2,07,200. 2,07,200 is there in your ledger, and hence from this you will be in a position to subtract 21,000 and whatever number. However, the 51,800, against that you should be taking 5,400. Now 51,800 is not there in your ledger. You cannot record an impairment on an item which is not even appearing in your books of accounts. There's nothing else on the other assets, and hence there will be no adjustment for 54,000 because 5,400, because it has to be subtracted from 51,800. Since 51,800 is not recorded, 5,400 impairment of that also cannot be recorded. But since 2,07,200 is recorded, 21,600 should be recorded on that. The entry for this would be consolidated retained earnings. This will be impacting the parent only to, let us say, the goodwill, and hence this will come at 21,600. And finally this takes care of all the adjustments. So over here, if you go to see in the goodwill workings, you will have less goodwill written off from the consolidated retained earnings. Goodwill written off, let us say this is 21,600, and whatever goodwill you have calculated minus, let us say, impaired. This is 21,600. There will be no further impact on the NCI. So this is 2,07,200 minus 21,600, and hence this will give you the goodwill that should appear in your balance sheet on 31st March 20x4. This is 1,85,600 of goodwill. Now you are in a position to balance the three crucial working notes as well. 2865 minus 15 plus 1960 plus 2,01,600 minus 21,600, and this comes to, I guess, 31,960. Within other equity, this is 12,70,000, and if I total both of these, 12,70,000, I guess this is 43,01,960. Then there would be the total for NCI. This is what? 1,193,200, 5,000, 50,400, and 5,000. So this is 353,600 for the NCI. Now, if I just try to total up the numbers in the balance sheet, there was just one more thing. In the investment, you will subtract 14 lakh. 15,000 you will subtract because it has to go to the PNL, and 14 lakhs is eliminated as a part of goodwill working. Having said that, everything else should be in line. So if I look at the PP, this is 26 lakh 20,000. To this you will add 37,050. That will come to 26,57,050 for Ishwar, and then 18 lakh 50 plus 50,000 plus 1 lakh 50 plus 1 lakh minus 15 minus 75. This probably comes to 47 lakh 17,050. This is at the CFS level. Investment 2115 minus 1415, you will get 7 lakhs of investment plus nil. So investment will be 7 lakhs. Apart from that, there will also be goodwill, which is 1,85,600, if I am not wrong. 1,85,000 kya hai? 600. Yes, that will be your goodwill. Inventories continues to be the same. There is no adjustment. So this is what? 9,75,000. Trade receivables, I think this is 7,80,000. Cash and cash equivalent, this is what? 75 and 60, 1,35,000. And that should ideally give you your total assets in your balance sheet. So this is what? 47,17,050 plus 7 lakhs plus 185,600 plus 975 plus 780 plus 135. I pray to God this is your answer. Neither do you or I have the capacity to go further. So this is 650. Share capital will be the parent share capital, which is 7 lakhs. Your total combined retained earnings that we calculated is 43,01,960. 43,01,960. Apart from that, there will be a non-controlling interest, which is 353,600 353,600. On the provisions, there is 6250 plus 35090, 41,340, 413,750 and 4,50,000 comes to 863,750. Deferred tax, you have some adjustments. 225 plus 1,40,000 plus 54 minus 12, 4,07,000. Trade and other payables, I think this is what, 5,50,000 after all adjustments, and 2,75,000. Let us try to total this once. This is what, 7 lakhs. This is a stage where our heartbeat aces when we are in the exam. 353,600, 41,340, 863,750, 4,07,000, 5,50,000 plus 275, 74,92, 650. Badhai ho. Congratulations. Somehow, at least in a non-exam scenario, we've managed to do this. This is typically coming in the diploma IFRS type of questions where you are given Excel. Obviously, you kind of in DIP IFRS paper, you solve it on the computer. You have Excel and everything at your hand. And it's a 25-mark question which is done through Excel and everything. It's kind of given to you over here. I mean, there are a few interesting concepts. They've done it in a slightly different way. But if you go to see, your final answer should ideally tally. Let me just verify. 74,92, 650. Perfect. PP is 47,17,050. Goodwill is 185,600. The crucial numbers: retained earnings 30,31,960 and 12,70,000. And then there is NC at 3,53,600. So that, I guess, we'll have to do this RTP, I guess, the way it is. It's fairly complex. The first 3-4 questions, at least the first question 1, question 2 to some extent, and mostly question 4 are very complex. So I'll kind of take a pause over here if required, and probably will continue into the next session. Don't worry, the other questions are not as lengthy and as long. There are a few other interesting questions as well. So hang on, I'll see you in the next session where we will continue and do the other part of the RTP and also the amendments. I hope this has been helpful to you. Do let me know if you have any questions in the comment box, and I'll see you soon with the next part of this video. Hello everyone, and welcome to this next session for discussion for the November 2023 RTP. In the first session, we have discussed the 4 initial and lengthy questions. Next, we go to the other questions. Thankfully, they're not as lengthy as the earlier ones, but nevertheless, a few of them are important. So we'll proceed further on to question number 5. This is very similar to a question, or rather exactly same as a question in the study material, as well as I think question number 7 or 8 of our class. So we'll just quickly review them, discuss, and then proceed further. Question number 5, Ind AS 20. An entity opens a new factory and receives at the beginning of the year a government grant of 15,000 in respect of capital equipment costing 1 lakh rupees. So this is a grant specifically for a capital equipment, and hence this will be treated as a grant linked to assets as per Ind AS 20. If it is a grant linked to asset, it can either be reduced from the cost of the asset, or it can be shown as a deferred grant separately in the balance sheet and the asset appearing at the entire 1 lakh amount. It depreciates all plant and machinery at 20% per annum using straight line method. Assume that there is a reasonable assurance that conditions attached to the grant will be fulfilled, and consequently it means that you will initially recognize a grant. For year 1, pass the journal entries and show the presentation of the effect of this grant in both the balance sheet and the statement of profit and loss under both methods permitted under Ind AS 20. So if it's a grant which is linked to assets, the 2 methods which are permitted under this grant would be, you will reduce this from the cost of the asset. So over here you can show your PPE initially at year 0, initially at 85,000, that is 1 lakh minus 15,000, and then you will depreciate the asset. Depreciation is at the rate of 20%, and 20% of this will be, I guess, 17,000, and as a result in your balance sheet within non-current assets you will see, I guess, 68,000 if I'm correct, 68,000 worth of PP, and in your statement of profit and loss account you will see 17,000 which is depreciation and amortization. That's it. That is under the first method. The journal entry for this would be, initially you will pass the entry asset account debit 1 lakh to bank 1 lakh, and then when you receive the grant, bank account debit 15,000 to asset 15,000, then depreciation account debit to asset 17,000, and that's it. When you look at the second method, under the second method you will recognize the PPE entirely at year 0 at 1 lakh only, but at the same time there will be a deferred grant account as well. At year 0 your deferred grant will appear at 15,000, and this deferred grant will be amortized in the ratio of depreciation, which is equal in this case. So over here when you calculate the depreciation for this item at 20%, this will be 20,000, which will go to the profit and loss account, and hence this will appear at 80,000. Non-current assets, property, plant and equipment 80,000, and there will be amortization. This amortization will be taken to the profit and loss account at the rate of 20%. This is going to be 3,000, and hence you are left with the remaining 12,000. So if you open your balance sheet, deferred grant will appear at 12,000 and PP will appear at 80,000. A couple of interesting points to remember, at least in the second method, would be that when you are preparing the statement of profit and loss account, the depreciation will appear separately at 20,000 and amortization of the grant will appear separately at 3,000 in other income. You will not net them off. It is not permitted to net them off. You will show them separately, depreciation as well as deferred grant. In a similar way, when you prepare the balance sheet within non-current assets, the PP will appear at 80,000, no problem in that. However, when you are looking at the deferred grant, which appears as a part of liabilities, you will segregate this. You will say, well, a part of this will appear as current because it is expected to reverse, that is materialize within the next 12 months. That is 3,000. Every year 3,000 is written off, so within the next 12 months another 3,000 is expected to be written off, and hence this is treated as current. And beyond that, over here you would treat this as non-current. So this would be 12,000 minus 3,000. Let us say we can directly take 9,000 as a part of non-current in the balance sheet disclosure. So if we were to pass the journal entries in the second method, it will be PP account debit, let us say 1 lakh to bank 1 lakh, bank account debit 15,000 to deferred grant 15,000. Then you will depreciate the PP, depreciation account debit I think 20,000 to PP 20,000, and then amortization of the grant, deferred grant account debit to amortization, let us say 3,000. So this is how the workings will proceed. So that takes care of question number 5, a fairly manageable question, I would say. Now question number 6 is on Ind AS 8. Now the initial part of the question is very similar to what has been done, I think, in question number 10 in your books, as well as one of the institute study material questions, but there are a couple of other additional points over here as well which we need to cover up. So let us read this question. In the financial statements for the year ended 31st March 2022, Y reported 73,500 as revenue, 53,500 as cost of sales, 6,000 as income tax, 20,000 as retained earnings at the start of the year, and 34,000 as retained earnings at the end of the year. So if I look at the income statement that is given, you have the revenue given, the COGS, the income tax, everything has been provided. Okay. In the year 2002-3, that is the next year, 22-23, after the 21-22 financial statements are approved for issue, this is after the post balance sheet period, Y Limited discovered that some products sold in 2011-12 were incorrectly included in inventories at 31st March 12 at their cost of 6,500. So basically your inventory appears to be overstated. The closing stock of 31st March 2012 appears to be overstated. Now if I calculate, let us say, if I look at question number 6, your COGS is calculated as your opening stock plus, let us say, purchases for simplicity, less, let us say, the closing stock. So if I look at the year 2000 and let us say X2, X3 and 2000 and X1, X2. So there are 2 years, 2000 and X1, X2. In this case, the closing stock is overstated by 6,500, and if the closing stock is overstated, one needs to remember that if the closing stock is overstated, the impact on the COGS, let me just write this over here, let us say this is equal to COGS. So if closing stock is overstated, your COGS is understated, so this will reduce your COGS. Your COGS is lower by 6,500. On the other hand, in the next year, if your closing stock is higher, that means your opening stock is also higher. So the question tells you that Y discovered that some products were incorrectly included in inventories on 31st March. So your inventory is overstated, your closing stock is higher, then your COGS will, let us say, be lower. In a similar way, in the next year, if you go to see, your opening stock will be higher by 6,500. If your opening stock is higher, all else remaining constant, your COGS will also be higher by 6,500. So this is the error in your COGS. So your error in the COGS is 6,500, which is higher in the year 20x2 and 20x3 and lower in the previous year. So in order to rectify, you will have to reverse the effect. So in order to rectify this, you will have to reverse the effect. Okay, so we will do that. Point 1, we will just review what is to be done in the second point. In the year 20x2, 20x3, that is 22-23, why change the accounting policy for measurement of investments in associates after initial recognition from the cost model to the fair value model as per Ind AS 109? Remember, there is an Ind AS 27. Ind AS 27 says that in your SFS you can record investment in associates, subsidiaries or joint ventures either at cost or following Ind AS 109. You have decided to follow the cost method, but now you want to change it to the fair value method. Unless given otherwise, this will be fair value through profit and loss. It can also be FVOCI, but if nothing is given, by default the equity investments go in FETPL. It acquired its only investment in associate for 3,000 many years ago. So this must be appearing at cost only. The associate's equity is not traded on a securities exchange, that is, a published quotation is not available. So level 1 category input is not available. The fair value of the investments was reliably determined using an appropriate equity valuation model, which is permitted on 31st March 23 at 25. In the year 21-22, it is 20,000. And in the year 2021, it is 18,000. So, is this a change in accounting policy? Yes, this is a change in accounting policy. The first point pertain to error. Remember, error needs to be retrospectively restated. So, we will retrospectively restate the error and give the necessary disclosures as required. Second is a change in accounting policy. If it's a change in accounting policy, again this requires a retrospective restatement. If this pertains to a period prior to the earliest year presented, the opening balances also need to be restated. So over here there will be a retrospective restatement for the opening balances as well. We'll see how to take this forward. As on 31st March 20x3, as a result of usage of improved lubricants, why reassess the useful life of machine from 4 years to 7 years? Now this is a change in the useful life of the asset from 4 years to 7 years. Machine is depreciated on a straight line method to a nil residual value. It was acquired for 6,000 on 1st of April 20x0. Now this refers to a change in the estimated useful life, and if it is a change in the estimated useful life, it is a change in accounting estimate. So this is a very good question which shows you the impact of accounting estimate change, accounting policy change, as well as an error. Next, inventories for the type manufactured by machine A are immaterial at the end of each reporting period, so that's fine. So there would be no material inventories coming out of this item, so there will be no change in the inventory closing stock cost. Wise accounting records show for the year ended 20x3, before accounting for a change in policy and change in estimate, 1,04,000 as revenue, 86,500 as COGS, including the 6,500 error in the inventory, 1,500 depreciation for machine, and 5250 as income tax. So this is reported. We will have to restate this. Why presents finance statements of 1 year comparative information? For simplicity, the tax effect of the incomes and expenses should be assumed at 30% of the gross amount. So there would be changes in tax as each of these consequent amount will change as well. So this is for simplicity, will not take any further deferred tax or any other implications, directly 30%. Draft and extract showing how the correction of the prior period error, change in accounting policy and the change in accounting estimate would be presented in the statement of profit and loss and the statement of changes in equity pertaining to the retained earnings and disclosed in the notes to accounts of Y for the year ended 31st March 20x3. So notes we will just discuss what is to be done, but primarily we will see how the impact is to be presented in the profit and loss and in the retained earnings statement. So over here, if I were to refer to the statement of P&L, profit and loss, there would be 2 years. There is a 20x2, 20x3 which you call as the current year, and 20x1 and 20x2 which is the comparative previous year. So there is certain revenue which is presented. Now does the question tell you that there is any error in the revenue? My sense is no, and hence whatever is the revenue presented, you will take it as it is. So over here this is 1,04,000 for the current year, and I'll just highlight the revenue to be taking 73,500 in the earlier years. So this is 1,04,000 and 73,500. Apart from that, we look at COGS. Is there an error in the COGS? The answer is yes, there is an error in COGS which is stemming from the fact that there is a wrong reporting of the 6,500 inventory. So if you look at the COGS for the current year, the COGS for the current year, let us say, includes 86,500 cost of sales, which includes the 6,500 error in the opening inventory and also 1,500 as depreciation. So this COGS or COS includes even the depreciation. So this is going to be 86,500. Now in the current year, opening stock is overstated. Opening stock, what does it do? It increases the COGS and hence the opposite impact. Rectification will be the opposite impact, that is you will reduce the COGS. Opening stock was overstated, you reduce that, so your COGS falls by 6,500. Apart from that, in the earlier year, if you go to see, your COGS appears to be 53,500. This is lower because your closing stock was higher and hence you will increase the COGS. So for example, over here we will take 53,500 plus 6,500. We will wait before we total up. This is the impact for the change. This is the impact for the error. So in the notes you will disclose that there was an error because of which there is a 6,500 increase in the COGS in the earlier year and a reduction of 6,500 COGS in the current year, which will also have a consequent impact on taxes at the rate of 30%, which we will see below. Okay, so this takes care of the error. Accounting policy change, well, we will do it as a separate line item, but there is some depreciation. Now over here, in my opinion, there is an alternative treatment possible, though institute has done it in a particular way. We are doing it in that way, not that it is wrong, but an alternative treatment is very much possible. So at 31st March 20x3, as a result of improved lubricants being used, why reassess the useful life of machine A from 4 years to 7 years? This is 4 years overall, 7 years overall, unless given otherwise. Machine A is depreciated on the straight line method and was acquired for 6,000 on 1st April 20x0. So if I look at the impact on the machinery adjustments, ideally, what will be the carrying value of the machinery? And this is a change in accounting estimate and hence it has to be prospectively applied. So over here, 1st April 20x0. So over here, this is I think 6,000 minus depreciation. This is depreciation for the year 20x0, 20x1. This is going to be 6,000 divided by, you estimated 4 years and 1 year has gone by. So this is going to be 1,500 in the first year, comes to 4,500. This is the balance on 1st April 20x1. Remember, your estimate changed in the year 20x2, 20x3 and hence there will be no retrospective restatement. So minus the depreciation on 20x1, 20x2. Yes, you are showing it as a prior year. However, remember, it is a change in accounting estimate. The change in the useful life of machinery is change in accounting estimate, and this has happened in the year 20x2, 20x3, and as a result, there will be no impact in the comparative previous year. Again, the depreciation will be calculated in a similar way. You can either find this as 4,500 divided by 3 into 1 or 6,000 divided by 4 into 1. This still comes to 1,500, and hence your balance would be, I guess, 3,000. This must be the balance on 1st of April 20x2. Now, there are two ways in which you can interpret. One can always say that, well, the change in estimate happened on 31st March 20x3 and as a result, we will give the impact from the year 3-4 onwards. Alternatively, and practically, this is what does happen. Management sits to finalize the accounts at the end of the year, and at the end of the year it kind of says that, well, you know what, I've not really charged the depreciation for the current year, but I do believe that the life of the asset now is overall 7 years, and hence you have to do the working based on the latest estimates. It is like saying that when you do ESOPs, you take the number of employees which are estimated to remain at the end of the vesting period, and this estimate that you take is the latest estimate that you have at the end of the year. So if at the end of the year your estimate is that overall the life of the asset, it is not just given that the remaining life is so and so, that means that the depreciation has already been charged. No, it applies that the overall life is 7 years, and hence it is a reasonable assumption to make that the depreciation for the year 20x2, 20x3 has not been recorded. So might as well we'll record it on the most reasonable basis, and that is based on the most latest estimates. So the latest estimates over here would say that the overall life of the asset is 7 years, out of which 2 full years have gone by, and hence 5 more years are remaining. So this 3,000 that is remaining has to be spread over the remaining 5 years. Now, how did we get 5? 5 is 7 minus 2, the first 2 years that have gone by, into 1, and as a result, this will be what, 3,000 divided by 5, if I'm not wrong, this is going to be 600. So ideally, the depreciation of the current year would have been 1,500. Instead, the depreciation is actually 600, and hence, if you go to see, the depreciation is lower by 900. So if I just chart out the trajectory going forward, so this will be, I think 2,400. remember this is sufficient when we are doing the workings for our current year. But remember, when there's a change in accounting policy, the standard also mentions that in the notes to accounts, you have to disclose the impact. So we will say that, okay, in the current year, because of the change in accounting estimate, your depreciation reduces by 900. Sir, how 900? Ideally, the depreciation in the current year would have been 1500. And as you can see on the next page, the depreciation has been recorded, as a matter of fact, at 1500 only. For machinery, the depreciation is recorded at 1500. Instead, you will have to now show this at 600. So the depreciation in the current year reduces by 900, and hence that will also have a 30% income tax impact. But in the next year, ideally, had the same estimate continued, even in the next year the depreciation would have been 1500, but now in the next year also the depreciation would have been 600, and as a result there would be a lower depreciation to the tune of 900 even in the next year. However, under the existing estimate of useful life, after the next year, that is the year 2023-24 is over, 4 years would have been over, and hence there would be no further depreciation in the next 3 years. However, in the current method, there would still continue to be depreciation of 600 in the 3 subsequent years after the next year as well, and hence that is just outlining the impact of the depreciation in the subsequent years to the extent it can be traced. So over here, there will be 600 worth of depreciation. So currently, if you go to see in the 86,500, you have subtracted 1500 of depreciation, or you have considered 1500 of depreciation. Now instead of 1500, your depreciation is only 600, and hence you will reduce further 900. Ideally, should only 600 worth of depreciation should have gone, 1500 has gone, and hence 900 should be reduced over here. So again, sir, should you do that similar working in the last year as well? My answer is no, primarily because this is a change in accounting estimate, will be prospectively applied. The prospective application is assumed to be application from the year 2002-3. That is what the institute has done. It is reasonable. Practically also people do that because they reassess lives at the end of each year. However, a student, strictly speaking, can always say that no, the depreciation must have been recorded in the current year, so we want to give the effect from the next year. That is theoretically possible. The institute over here has given effect in the current year because there is a change in estimate. An alternative solution, in my opinion, is possible over here. So this is 86,500 minus 6,500 minus 900, and hence this comes to, I think, 79,100. Similarly, this comes to, I think, 60,000, and hence this will give you, let us say, a profit of 1,04,000 minus, so this is 24,900 and 13,500. Ideally, we will charge the tax at the rate of 30% on this. However, there is also a change in accounting policy. Now, due to the change in accounting policy, we have a situation where there would be certain changes due to the investment amount. So your investment in your associate at cost appears at 3,000. Now you are changing the policy from cost to fair value, and hence this will result in a retrospective change. So in this particular case, you will record the changes retrospectively. So if we were to do these changes retrospectively, then we will, let us say, start with the retained earnings so that we show all the possible impact properly. We start with the retained earnings. So this is the balance on 1st April. What is the first year? 20x1. Ideally, we should search the question for finding the retained earnings balance on 1st April 20x1. Do we have that somewhere? This is 1st April 20x1. There you go. Retained earnings at 1st April 20x1 was 20,000. So if you look at this 20,000, why should this 20,000 change? Well, ideally, the error has no impact on 1st April 20x1. If there's a change in estimate, in any case, we do not do a retrospective restatement. However, there would be a change in accounting policy. So this is plus, let us say, due to changes in accounting policy, change in accounting policy on investments, which is now going from cost to, let us say, FVTPL. Unless given otherwise, we will take it to fair value through profit and loss. Now, when we go from cost to, let us say, FVTPL, your cost is 3,000. Fair value today, if you go to see, is around 25,000. However, on for the year 2020x1, the fair value was 18,000. So the appreciation from 3 to 18 has already happened prior to the earliest reported period, and hence if we take the difference, this is 18,000 minus 3,000, and hence that is 15,000. So there is a 15,000 increase in the opening retained earnings, investment debited by 15,000 and retained earnings credited by 15,000. So this would come to, let us say, 35,000. Again, we need to see if there is any tax impact. The question kind of assumes that every gross changes will have a corresponding tax impact, and hence from this we will also subtract the corresponding tax impact. Sir, we have not subtracted the tax impact on other items. Well, we have not subtracted because it will automatically get incorporated. When we find the tax over here, the impact will automatically get incorporated, but this 15,000 is not going in the statement of P&L, and hence the tax impact on the same has to be considered. So this is 15,000, let us say, into 30%. If I am not wrong, this comes to 4,500, and hence your restated balance on 1st April 20x1 after considering, so this is 35 minus 4,500, this will be 30,500. Now this 30,500 will increase due to the profits which are restated, as you can see. So this will increase due to the profits, but before you calculate the profits, we have to see that the investments are now worth 18,000 on 1st April 20x0, but then as 1 year progresses, it goes from 18 to 20 and then from 20 to 25. So over here, plus fair value gains on investments, this will go in the profit and loss account. Retrospective restatement, this is called as retrospective restatement. So this is, let us say, 20,000 minus 18,000, and this will come to, let us say, 2,000. Additionally, you will have 25,000 minus 20,000, and hence this will come to additionally 5,000. This is a gain, and hence you will find the profit before tax. So this will be PBT, profit before tax. This I think is 29,900, and this is 15,500. On this there would be a tax impact which considers everything. Now if I take tax at the rate of 30%, this 30% takes into consideration the errors in 6,500, the additional depreciations or reversal of depreciation, the fair value changes beyond 18,000, everything is covered over here. So this is 29,900 into 30%, this is 8970, and that will give you profit after tax, which you will carry. So this is 20,930, 15,500 into 30%, this is 4650, which will give you 10,850. So there are no further dividends given. So if I consider the retained earnings, this you will take the restated PAT. Obviously there would be notes where you give a lot of explanations, but for a concept level understanding over here, 20x1, 20x2, this will be 10,850, no further dividends, and hence we are getting what? 30,500 added 41,350. This will give you the restated balance. This will be the restated balance on 1st April 20x2, on which you will add the restated profits. Again you will add the restated PAT, which is on 20x2, 20x3. This is, I guess, 20,930, and hence you will get the final restated balance. Final restated balance on 1st April or 31st March as a case, maybe 31st March, 20x3 plus 20,930 comes to 62,280. This is the impact in your statement of changes in equity. Apart from that, if we just kind of quickly review and just check whether this is in line with your institute's solutions. So 20,930, 10,850, perfect. And if you look at your statement of changes in equity, the final statement of changes in equity will show 62,280, perfect. So that takes care of question number 6, a slightly interesting question. I would rate it as important as well. Next we go to question number 7 on Ind AS 12. This is again on a slightly different and a slightly deeper adjustment. Now question number 7 is on Ind AS 12. In this particular question you have two bifurcations. One, there is a PP which has a difference which is other than temporary. Now when you study Ind AS 12, if the differences are what you call as loosely permanent, that is other than temporary, then we create no deferred tax. Perfect. So the question starts and ends over there. There will be no deferred tax implication if the difference is other than temporary. Perfect. However, there might be some additional differences which may get created which are, let us say, temporary. In which case deferred tax will be created only for that part which is, let us say, temporary. Now this question builds up on a concept that we would have, if I'm not wrong, done in question 11 sub.2 of our books, or in the study material. There's a question where you have PP which is revalued and depreciated. In that case, if you remember, there were two differences that were arising or reversing. First is a difference due to revaluation which goes through the OCI. Second is a difference which is due to depreciation which goes in the profit and loss account. Now in case a part of these differences were other than temporary, the question tells you they are other than temporary, then there will be no deferred tax on one of them. If both of them are other than temporary, there would be no deferred tax on both of them. However, if the question tells you that one of them is other than temporary, which means the other one is not, then there will be a deferred tax implication. Remember, you are solving an FR paper, not a tax paper, and hence generally what we do assume is if nothing is given, even in business combination or deferred tax, we assume that the differences are temporary unless a question tells you otherwise. But if a question actually points out that the differences are temporary, differences are other than temporary, you will ignore them for the deferred tax calculation. But that does not mean that there cannot be any other additional differences on which deferred tax may have to be calculated. So let us keep that into mind and go to question number 7. On 1st April 20X1, an entity which is paying tax at the rate of 30% acquired a non-tax deductible office building. For whatever reasons, maybe depreciation is not permitted as per income tax, or this is an ineligible item, whatever be the reason, this is treated to be a non-tax deductible office building for rupees 1 lakh. Okay, in circumstances which Ind AS 12 prohibits the recognition of a deferred tax liability associated with the temporary difference of 1 lakh. So probably there is no difference and hence no deferred tax. Probably the difference, if any, is other than temporary and hence no deferred tax, or probably there are certain exceptions or circumstances which prohibit the creation of deferred tax. Basically, the question points out very clearly that it is a non-tax deductible office building and hence there will be no deferred tax implications on this 1 lakh as well. At the same time, it mentions prohibits the recognition. It prohibits the recognition of deferred tax liability associated with the temporary differences, if any, pertaining to this 1 lakh of office building. Okay. The building is depreciated over 10 years at the rate rupees 10,000 per year to a residual value of 0. Okay. So, see, income tax may not allow you to kind of claim any tax deduction on this 1 lakh. However, that does not mean that in the books you will not record depreciation. In the books you will still keep on recognizing a depreciation. 1 lakh divided by 10, that is 10,000 per annum. So in the first year it will be 1 lakh, then 90,000, 80,000, 70,000 and so on. After 10 years it will become 0, at least in your books of accounts. Carrying value refers to the value as per Ind AS. Tax base is the value as per income tax. Here the carrying value is the value as per Ind AS, which is 1 lakh in the first year, 90,000 in the second year, 80,000 in the third year and so on. The financial year ends on 31st March. On 1st April 20X2, that is 1 year later, the carrying value of the building is 90. Now, this is the value as per Ind AS. How did this 90,000 get calculated? 1 lakh minus 10,000. And it is revalued upwards by 45,000 to its current market value of 1,35,000. So, over here, there is a revaluation happening of 45,000. There is no change to the estimated residual value of 0 and to the useful life of the building after revaluation. So basically there is no change other than the revaluation. Is a question anywhere telling you that the revaluation results in a difference which is other than temporary or so? No, it does not. So probably this results into a difference for which tax may need to be payable. Now how is it payable? We are, remember, solving an FR paper, we are not solving a tax paper. Probably income tax tells you that you can buy a particular asset, it is giving you certain benefits, and it is telling you that I will not allow you to claim a tax deduction for this 1 lakh, maybe in the form of depreciation. In the books also you are getting a 10,000 depreciation, income tax also probably a depreciation which is not allowed to be deducted. However, that does not mean that the Income Tax Act tells you that I will not charge you tax on, let us say, profit on sale. It is very much possible that, let us say, at the end of the first year, if the asset was to be sold at 1,35,000, income tax would say, well, you know what, 1,35,000 is the proceeds that you get from the asset, 1 lakh was the price that you paid for it, of which 1 year has gone by, 10,000 you reduce, so your carrying value is 90. Again, I am not allowing you a deduction. There may be certain income tax provisions which might say that if you are claiming a particular benefit, you cannot claim a deduction for this asset. I'm not very sure, but maybe items like section 35 AD etc., which sometimes allow 100% capital deduction of an asset or sometimes disallow. We don't know what the actual mechanics are. We are just told that it is a non-tax deductible asset, but that does not mean that it is an asset on which there would be no profit on sale that will be charged. There will be a profit on sale unless given otherwise. If the question had also told you that it is non-tax deductible as well as the capital gains are non-taxable on this asset, then all of these differences are other than temporary. However, the question refrains from telling you that. It just tells you that you are not going to get any tax deductible value on the 1 lakh of office building, but it does not really tell you that you may not be taxed on a higher proceeds that you might get on the asset. So over here, if I were to sell the asset at the end of the first year, then 1,35,000 I would get against an asset which is at 90. Again, income tax will not charge you entire 1,35,000 as capital gains. No, it will say that you have paid 1 lakh for the asset, 1 year has gone by, 90,000 is the value of the asset today, for which you are getting 1,35,000. So I will charge you a capital gains, let us say, of 45,000. So have you actually sold the asset? The answer is no. If you have not sold the asset, then income tax is not charging you any tax right now. However, in the books of accounts, you are following a revaluation model. If you are following a revaluation model, then under the other comprehensive income, there would be a revaluation gain which will be recorded to the tune of 45,000, for which you are not going to pay any tax now. However, when you actually sell the asset, you will have to pay tax. And as a result, for this 45,000, there would be a deferred tax. Now, typically we calculate the carrying value, we calculate the tax base, we calculate the difference, and then we kind of find the deferred tax, which can be done over here as well, but it is a little more complicated. So there can be alternative methods that you can follow, but one needs to remember that this 45,000 gives birth to deferred tax. Okay, determine the carrying amount, depreciation for the year ended 31st March 20x3, that is for the second year, and deferred tax thereafter till the useful life of the building. Okay, for the entire useful life of the building. Further analyze the treatment and impact of deferred tax since 31st March 20x3 till the useful life of the building. So there are various ways in which you can solve. Institute has prepared a table. You can also go ahead and do the same. Alternative versions are possible though. So when we are looking at, let us say, question number 7, for your underlying item, which is a property, plant and equipment, ideally we look at the carrying value, we look at the tax base, we look at the difference, and then we calculate deferred tax liability, if any. Are you given the tax rate, or deferred tax asset as a case may be? Are you given the tax rate somewhere? I guess yes, first line, tax rate is given to you as 30%. So if I look at the value at year 0, your carrying value as per Ind AS is 1 lakh. At year 0, your carrying value as per Ind AS, let us say, is 1 lakh. Your tax base can also be taken as 1 lakh, in which case you would say that, okay, there is no temporary difference and hence no deferred tax. However, income tax, you are going to say that this 1 lakh is non-tax deductible. And as a result, if this 1 lakh is non-tax deductible, we can say that in the Income Tax Act, there would be no consideration for this 1 lakh rupee worth of asset, and hence the difference over here comes to be 1 lakh. However, this difference is, in a way, simplistically put, this difference is, let us say, a other than temporary. There would be an other than temporary difference for which there would be no deferred tax that can be calculated, or institute I think calls this as some unrecognized values or so. You can give any nomenclature, but basically for this 1 lakh, you would say that, well, there would be no tax consequences if there are any other temporary differences. So if there are other temporary differences, then you create a deferred tax. But this entire 1 lakh is for something that income tax does not give you any deduction, and hence we are treating this to have no deferred tax consequence, at least at year 0. Then when you go to year 1, this is before revaluation. If you remember, we have done similar sums where we kind of try to first find the impact after considering depreciation and then take the revaluation separately. I think question 11 sub.2, you should refer that once for a better understanding. In the carrying value, this is as per Ind AS, which is 90 tax base. Still, we are not considering anything in income tax. So we are saying 90,000. So basically, there was a 1 lakh rupee asset in the books, which is now becoming 90,000. So 10,000 apparently has reversed under books of accounts, but in income tax, you did not get any impact of that 1 lakh. There is no further impact of this 10,000 as well, and hence the difference one can say is 90,000. Out of this difference, we can say the entire 90,000 is for an item for which deferred tax is not to be calculated, and hence there will be no further deferred tax liability. However, if you look at the revaluation as well, so if you look at the situation after revaluation, let us say in year 1, the carrying value becomes 1,35,000, tax base let us say is nil. The difference over here, let us say, is 1,35,000. Out of this 1,35,000, we can say 90,000 is that item of difference for which there will be no deferred tax impact. 1 lakh is non-taxable, there will be no deferred tax. That 1 lakh may say 10,000 of depreciation is getting reversed. If 1 lakh has no deferred tax consequence, the 10,000 reversal will also not have any deferred tax consequence. However, what about the remaining difference? The remaining difference, if you go to see, is over here 45,000. Will this 45,000 create deferred tax? Well, definitely yes. So this is 45,000 into 30%, which comes to, I guess, what? 45 into 30% comes to 13,500 of deferred tax liability. This will be routed through the OCI because typically revaluation goes through the OCI. Similarly, if you go to the second year, we are not really given anything about any further revaluation. So you will continue depreciating. This 1,35,000 will be depreciated over the remaining 9 years, that is 15,000 per annum. Hence, this will become 1,20,000. This 1,20,000, again, this will be 0. The total difference is 1,20,000. However, one can say that out of this 1,20,000, now it is 80,000 worth of differences. Originally 1 lakh minus 10,000 of that 1 lakh reversed in the first year, minus 10,000 of that 1 lakh reversed in the second year. 80,000 of these differences, which are pertaining to items which are other than temporary, which means the remaining 40,000 of differences on which there would be a deferred tax liability. This is 40,000 into 30%. I guess this is 12,000, and so on. You can keep on going further on this. This is what? 1,05,000. You can keep on doing this for the entire useful life. The difference is 1,05,000. On the 1,05,000, this will now be 70,000, and there will be 35,000 of differences, which is attributable to the revaluation, which if the asset is sold on the very next day, you will have to pay tax, and hence 35,000 into 30% comes to, I think, 10,500, and hence if I go to see for this 13,500, your entry will be probably your revaluation, which is a part of OCI, deferred tax impact going in the revaluation, tax impact going in the revaluation, in OCI debit to deferred tax liability. This is 13,500, and then in every subsequent time period, as you go to see, for every subsequent time period, the reduction is happening at 1,500. So each year 1,500 is getting reversed. So this is DTL account debit, let us say 1,500 to, let us say, revaluation, which is a part of OCI. Again, it will go as a deferred tax impact, not necessarily revaluation, a deferred tax impact that will go in the other comprehensive income. So if you go to year 4, for example, this will be 90,000. This will be a total difference of 90, 60. As you can see, this comes down to 30. 30 into 30% comes to 9,000, and so on. You will keep on going further for the remaining years. As you will see in the institute solution as well, they've kind of prepared a table which shows this movement. So if we just review what the institute has done, They've done this in a horizontal way: carrying value tax base, gross temporary difference, unrecognized temporary difference, and the recognized temporary difference. This arises largely due to the revaluation, and hence the deferred tax impact 13,500, 12,000, 10,500, 9,000, and so on. You can kind of do this for the other years as well. So this takes care of question number 7, a slightly problematic question, especially considering the fact that you have to also think about tax, and being CA students who are giving 2 groups, I guess the tax angle always keeps on coming in our mind. But however, in your FR paper you will assume differences to be temporary unless otherwise given, so revaluation is taken to be temporary. Other items would have also been temporary. Depreciation is usually temporary difference. However, in this question it is clearly given that this is non-taxable or non-tax deductible, and hence we have not considered that and taken only the deferred tax impact to the tune of revaluation. You will probably have to sit back and review this question again for a slightly better understanding. Remember the steps that we have done and proceed further. You should be able to correct this. Now question number 8, thankfully now we are going to slightly lighter questions. So question number 8 is a relatively easier question, I would say. It has a few interesting adjustments, but by and large you should be able to manage this. A company engaged in the provision of information technology products and services incurred the following expenditure during the development phase of its software product. This is an expenditure incurred during the development phase. Remember, Ind AS 38 tells you that expenditure incurred during the research phase should be expensed to the P&L, whereas expenditure during the development phase should be capitalized subject to certain conditions. So these are expenses during the development phase. That is to be offered to its customers. The entity also purchases some software from third parties for incorporating it into the end software product offered to the customer. So maybe I'm developing a software, but in that software I need to create certain plugins or applications which I'm buying from the third party. So this is also directly attributable. The company is in the process of launching it in the market for licensing to the customers. The company also takes the service of external professional software developers for such software development. So again, these expenses which are paid to the external developers are directly attributable to getting the software in the ready to use condition. Cost incurred in relation to development of its software product for the year ended 31st March 20x2 are as follows. So these are the costs incurred. Purchase price of the imported software, ideally this should be a part of the cost, so we should take 600. Employment costs, there is note 1. Ideally employment costs are the cost of developers, should be included. Let us read note 1. The software was developed in 9 months, that is ended 31st December 11, and was capable of being operating in a manner intended by the entity. It was brought to use on 31st March 12. The employment costs are for the 12 months, that is up to 31st March 12. The employees were engaged in developing the software and related activities. So you will capitalize items which are during the period it was expenses during the period was intended to be ready for use. Once it was ready for use, maybe for the next 3 months, for whatever reasons, it was not a very auspicious occasion and hence you did not put it to use. That does not really matter. In 9 months, the asset was ready for use, and hence the capitalization will happen only to the extent of 9 months. 1200 into 9 by 12, assuming the expenses have accrued evenly throughout the year, then 900 would be capitalized. Testing cost, we are assuming testing is directly attributable. This is pre-production testing, directly attributable to getting the software in the ready to use condition, should be capitalized. Other costs directly related to customization. Okay, there is a note 2. Other costs directly related to development include an abnormal cost of 50,000 in respect of repairing of a damage which resulted from a security breach. Remember, abnormal cost should not be added to the part of cost. Directly related expenses should be added, but this includes an abnormal item of 50, so you will remove that and the remaining 400 will be added. Okay, professional fees for external developers. We have seen earlier that these developers were necessary for the development of the software, and hence 220 will be capitalized. Cost of training provided to staff to operate the asset. This will not be capitalized. Training expenses are not treated to be directly attributable. Remember, the software is ready for use. The client's employees don't know how to use it. That does not increase the cost of the software. This will not be added. Cost of advertising in the market, selling and distribution expenses will not be added. Administrative and general overheads in usual terms, they are also not added, and hence if you go to see, the total cost would be 600, 900, 1800, 400 and 220. I guess this will be 3920. This will be the total cost of the software. What is the amount of the software development cost that will be capitalized? Explaining the reasons for each element of cost. We will explain the reasons as required, but otherwise I guess 3920 should be your initial cost. That takes care of question number 8. Now comes to the dreaded Ind AS 109. We think that, well, this is going as a fairly difficult RTP. 109 will also be very difficult. Thankfully, no. Institute has asked you regarding extinguishment accounting. If you remember, for financial liabilities, what is the principle? We will first calculate the carrying value of the loan, compare it with the present value of the modified cash flows at the old EIR. If there are any transaction costs, we will also consider those transaction costs. Try to find the present value of the modified cash flows at the old EIR. If the difference is greater than or equal to 10%, we apply extinguishment accounting, or else we apply modification accounting. So let us see this question number 9 on these lines. On 1st April 20x1, a bank provides an entity with a 4-year loan of 5,000 rupees on normal market terms, including charging interest at a fixed rate of 8% per annum. Interest is payable at the end of each year. Okay, so unless given otherwise, interest is payable at the end of each year. The figure of 8% is a market rate for similar 4-year fixed interest loans with interest being paid annually in arrears. So this is again loans at market terms. Transaction cost of 100 rupees is incurred on originating the loan. Remember, this is transaction cost. For a financial liability, transaction cost has to be subtracted from the financial liability in order to find the initial recognition value of loans which are recorded at amortized cost. If it is FVTPL, this goes to the profit and loss account. Effective interest rate, EIR, is 8.612%. Sir, but the coupon rate is 8, market rate is also 8. Yes, if coupon was the only component of cost, then your effective rate would have been 8% only. However, in this, apart from the coupon, you are also paying 100 rupee origination fee, and hence your effective cost of the borrowing is slightly higher, which you would have to calculate using IRR method. Thankfully, this has been given to you as 8.612%. So your initial recognition of the loan will come at 5,000 minus 100. From the entity's borrower's perspective, you have taken the loan, that is bank account debit, let us say 5,000, to loan, let us say 5,000, and then you have paid 100. So something account debit to bank 100. So initial recognition happens at fair value minus transaction cost, that is minus 100. So this is loan account debit 100 to bank, let us say 100, and hence the initial loan comes at 4,900. In 20x1-2, the loan was taken on 1st April 20x1, so this is 20x1, 20x2, that is the first year itself. The entity experienced financial difficulties, and on 31st March 20x2, that is the end of the first year, the bank agreed to modify the terms of the loan. Under the new terms, the interest payments of the 20x2, 20x3, 20x4, 20x4, 20x5, so that is 2, 3, 3, 4, 4, 5. I think next 3 years will be reduced from 8% to 5%. So your coupon rate, which was at 8%, is now going to be at 5%. The entity paid bank a fee of rupees 50 for the paperwork relating to the modification. So this is the slightly tricky part, where you have a transaction cost along with the extinguishment or modification treatment. Analyze whether the modification of the loan constitutes an extinguishment of the original financial liability or not. So how will you do this working? You will first try to find the carrying value on the date of modification, that is 31st of March 2020 x2. So if I look at question number 9, so point 1 is trying to find the carrying value as on 31st March 20 x2. So this will be year, your opening balance, this will be, let us say, 5,000 minus 100. And hence this will be, let us say, 4,900. This will be 4,900. There would be an effective interest rate at the rate of 8.612%, if I am not wrong, for the first year. 4,900 into 8.612%. This is, I think, 4 to 1.98 or 422 if I take the liberty of rounding off. Coupons, has the question anywhere told you that the company has defaulted on the coupon? No. And as a result, it is reasonable to assume that the company must have paid the first coupon, and then the interest for the next 3 years have been renegotiated. The question very clearly tells you that the interest payment of the year 2002-3 to 2004-5 have been renegotiated, and hence there is no change for the 2001-2 coupon. So this is 5,000 into, for example, 8%, and hence 400 worth of coupon will be, let us say, paid. And hence the closing balance would be what? 4,900 plus 422 minus 400, and hence this would be 4,922. This is the closing balance on 31st March 20x2. 2. You will have to compare this with the present value of the modified cash flows. Modified cash flows at the old EIR. The old EIR is 8.612%. So we'll try to find the present value of the modified cash flows. So modified cash flows year 0, that is on this very date. Will you have to pay a cash flow? In my sense, yes, you will have to pay 50 rupees. So the cash outflow will be 50 rupees today. 1, 2 and 3. In year 1, you will have to pay a cash flow of 5%. Achha, 5% of what? Well, principal amount is not paid. So 5,000 into 5%, I guess this will be 250 which is paid. This will also be 250 which is paid, and in the last year along with the 250 another 5,000 of principal will have to be repaid, and this will be discounted at the discount factor at the rate of 8.612%. At year 0 this is 1 divided by 0.08612. You can obviously use the annuity factors. So this is 0.9207, 0.8477, 0.7805, and hence you will have the present value. So over here this is 50, this is 250 into 0.9207, 250 into 0.8477, 5250 into 0.7805, and hence the total I guess comes to 4589.73. So this is the PV of modified cash flows at old EIR, and then you have to find a difference. Okay, so over here next you find the difference. The difference over here in step number 3 would be 4589.73 minus 4922 upon 4922 into 100. We have to see whether the difference is greater than, so this is around 6.75 or so percent difference. I am not very sure whether my numbers are exactly correct. Maybe there may be certain rounding of differences, but this is around 6 point something difference. Positive, negative does not really matter. The difference is less than 10%, and as a result there will be no extinguishment accounting. There will be no extinguishment accounting. In fact, you will treat this as a modification. What do you do under modification? You either alter the current carrying value, you bring it down from 4922 to 4589 and then keep the EIR constant at 8.612%, or you kind of do not make any changes in the current carrying value, you make it at 4922 only, and then you try to find the revised EIR taking 50, 250, 250 and 5250 over the next 3 years, and then see what your effective rate of interest comes to. So either of these would work. The question is not asking you to show the working, it just says analyze whether it constitutes an extinguishment of the existing financial liability or not. Our answer will be no. We'll just verify the numbers once quickly. So if we go to question number 7 is done, 8 just for reference, if we total up 3920, perfect, this was the value. In 9 we have shown all of these workings. Just a second, 4537 plus I think 50, if you add you will get almost the same answer. You have taken 4537 here, that 50 has not been separately added, they have added that 50 here again. So including the 50 rupee fee, the present value is 4587, that is the same, and we get around 6.8%, perfect. So there is no substantial modification, and hence extinguishment accounting will not apply. In fact, you will apply modification accounting in this question. Next you go to question number 10. This is on Ind AS 7. In my opinion, this is a fairly manageable and easy question. You can try preparing the cash flow statement format. I'll just quickly discuss what is to be done, but otherwise it's a fairly manageable question for cash flow preparation. So let us review this question. There is hardly any adjustment. What you have been given is, you have been given the profit and loss account, you have been given the balance sheets of 2 periods. Just a small thing to note, first you have been given the previous year and then you have been given the current year. This is a very basic trick that the institute uses to kind of throw you off guard. You usually believe that the earlier year will be the current year, the later year will be the previous year, but it can sometimes be the other way around. The original cost of the equipment sold during the year 20x2, 20x3 is 7 lakh 20. That's it. Prepare a statement of cash flows for the year ended 31st March 20x3. The question does not really tell you whether you need to prepare the statement using the direct method or the indirect method, and hence any of the two methods can work. But typically, if there are two balance sheets available, most of the times institute does uses the indirect method. Having said that, you can always use the direct method as well. You will get the same ultimate answers and the same ultimate marks unless the question tells you categorically to use a particular method. One of the subsidiaries of Buildwell submitted to the central finance its summarized statement of profit and loss and the balance sheet. So you have the profit and loss, net cash, cash cost of sales, depreciation. Remember, depreciation is non-cash in nature. Salaries and wages, operating expenses, provision for tax, basically that is tax. Net operating profit, non-recurring income, that is profit on sale of equipment. This is basically non-operating in nature. Then you have retained earnings. Retained earnings and profits brought forward. So this is your opening retained earnings. Dividends declared and paid during the year. This is usually a financing cash flow. This is declared as well as paid during the year, and hence 16 lakh 38 is the net increase. Okay, not 16 lakh 38, but this is your net balance. 16 lakh 38, it is a reconciled balance. So if you look at property, plant and equipment, if there are any changes during the period, land. So if you go to see, land increases, and hence this will be a cash outflow. This will in all likelihood be a investing cash flow. This is what 4 lakh 80 in the cash flow from investing, CFI, cash flow from investing. Land typically does not get depreciated. Next you have building. For this building and equipment, we'll have to kind of prepare a working note. So let us say if you look at question number 10, there will be a working note. Let us say for building, if you read the entire question, there are two accounts. One is the account for the building, and then at the end there will also be an accumulated depreciation account. So there are two specific accounts for building as well as accumulated depreciation. We will just see how to incorporate that. Opening balance is 36, closing balance is 57 lakh 80. 36 lakh and your closing balance is 57 lakh 80. So probably there are certain additions. There is clearly a sale, 57 lakh 60. I'm sorry, not 80. 57 lakh 60. Okay, so we'll see what is to be done. This amount is not yet reconciled. I know 4 lakh 80 is the cash flow from investing for land. Then there is cash. This will go as opening and closing cash and cash equivalent. So there has to be a net change of 1 lakh 20 during the year. 6 lakh plus 1 lakh 20 will give you 7 lakh 20. Inventories, over here inventories are actually increasing, and hence you will subtract it while calculating the cash flow from operations. This is 1860 minus 1680 comes to, I think, 1 lakh 80 reduction. Then trade receivables are falling. So this is 2640 and 9 lakh 60, they are falling. So this will increase by 16 lakh 80 again in the cash flow from operations under the indirect method. Advances, if nothing is given, we are assuming advances are operating in nature. That is what ICI has also assumed. They can also be assumed to be financing in nature, but this may be assumed as operating in nature. These advances are going up by, I think, 12,000. So increase in current assets you will subtract. So this is going to be reduced in the CFO. So all of these items have been taken care of. When you look at share capital, your share capital actually increases. If you go to see, this is 2002, this is 2003. So your share capital increases, and hence this is a cash flow from financing, 44 lakh 40 minus. So this is, I think, 8 lakh 40. This is going to be CFF, cash flow from financing. Surplus in the profit and loss account, 16 lakh 38. So if you kind of make the necessary adjustments in 16 lakh 38, the non-cash, the non-operating working capital adjustments, you will get your answer. Trade payables, there is a reduction in trade payables, and reduction in trade payables by 60,000. You will subtract this in the cash flow from operations. Outstanding expenses, again this is operating in nature. This is increasing by 2 lakh 40. Again this is going to go in the cash flow from operations. Income tax payable, you will probably prepare a separate working note for income tax as well. So over here, let us say there is a separate working note for income tax payable. You have to first add back the income tax to find the profit before tax, and then ultimately show a tax paid. So if I go to see my opening balance for income tax payable is 1 lakh 20, closing is 1 lakh 32. So this is 1 lakh 20. Excuse me for my presentation, this is 1,20,000 and closing I think is 1,32,000. Okay, and there is accumulated depreciation on building. This is 12 lakhs to start with and 13,20,000. So this is 12 lakhs credit balance to start with and 13,20,000. Now, if I were to start and prepare the cash flow from operations, my cash flow from operations usually starts at profit before tax. So when I look at my net profit, let's say if I'm looking at my CFO, I start at my profit before tax. In my profit before tax, I will have, I guess, 8,40,000, I guess, 8,40,000, and I will add back 8,80,000 as tax, 8,40,000 plus 8,80,000, and hence I guess this is what, 17,20,000. From this you will add back the non-cash items. Non-cash items over here is the depreciation. Depreciation is 6 lakhs non-cash, which will be added back. You will also consider the effect of depreciation in the accumulated depreciation account. So this is 6 lakhs worth of depreciation within the accumulated depreciation account. Apart from that, salaries, wages, operating expenses, they are all considered. 1,20,000 is non-operating in nature. So over here this will be subtracted. Let us say less profits on sale. Let us say 1,20,000. This will be subtracted. This is non-operating in nature. Now you have been told somewhere that the original cost of equipment sold during the year was 7,20,000. This is the original cost of the equipment sold. So over here, if I were to pass the entry for the sale, there would be some bank account. I don't know how much has gone in the bank. Bank account debit. Then there would be, you will have to remove the accumulated depreciation pertaining to this equipment as well. So accumulated depreciation account debit, we don't know how much is that. 2, you will say asset. So the asset that you are selling is worth how much? 7,20,000. So the asset which is sold is worth 7,20,000, and as a part of this transaction there will be profit on sale. There will be a profit on sale which is recorded at 1,20,000. For sure. So this is your entry. Now I don't know how much has come in my bank because that will be my cash flow from investing, and how much has gone in the accumulated depreciation account. So if I go to see in my asset, in my building, there will be, let us say by bank and by accumulated depreciation and to profit on sale. So if I do the proper posting, this will be the impact. Now I don't know how much is the accumulated depreciation, but if I go to see ideally 12 lakhs and 6 lakhs, my closing balance has to come to 13,20,000. 6 lakhs is depreciation of the current year. It is assuming it has taken everything into consideration. That is a correct depreciation of the current year, which means my closing has to be 13,20,000. However, if my closing is not 13,20,000, that means some of this has gone into the building sold, and hence that balancing figure, if I go to see, comes to, I guess, 4,80,000. So over here, this is what, 18 minus 13.2, just to be clear, 4,80,000, and hence in this entry 4,80,000 would be the accumulated depreciation, and hence the sale proceeds would then appear to be what, 12 plus 7.2 minus 4.8, it comes to, I think, 14,40,000. No, 7,20,000 plus 1,20,000 minus 4,80,000. I have done some really bad maths. This comes to 3,60,000 sale proceeds. Just to verify, does it make sense? 7,20,000 minus 4,80,000, that comes to 2,40,000. Perfect. 3,60,000 is the sale proceeds. So over here, this will be 3,60,000, accumulated depreciation 4,80,000, and profit on sale 1,20,000. Now, once you have given effect to these items, we'll just say accumulated depreciation effect is given, asset effect is given, profit on sale effect is given. 3,60,000 will go in the cash flow from investing. So if I were to prepare, let us say somewhere a CFI, there will be sale of building. I'm just doing this in rough. This comes to 3,60,000 positive cash flow. Apart from that, I will have to total up the building to find if there were no new buildings purchased. 3,60,000, 4,80,000, 57,60,000 minus 36 lakhs minus 1 lakh 20, and we get 28 lakh 80 of new buildings purchased. So this will be, let us say, purchase of building 28 lakh 80. When I look at my cash flow from financing, there will be equity shares issued. I think there is the only item. I guess that was 8 lakh 40. Equity shares issued 8 lakh 40, positive cash inflow, and you have dividend paid. This was also a financing item. The dividends paid in the earlier page, that is around 7 lakh 20. Now everything else is the working capital adjustments. So these working capital adjustments which we have done in the question itself. So if I just take the net summary of all of these working capital adjustment, this is 1 lakh 80 negative, 16 lakh 80 positive, 12,000 negative, 60,000 negative, and 2 lakh 40. So this is, I think, 16 lakh 68,000 all said and done. 16 lakh 68,000 all said and done, and then there has to be a tax paid. Now if I look at my income tax ledger, there would be, let us say, by income tax expense, I think this was 8 lakh 80. The provision for tax that was getting created was 8 lakh 80, and hence total is 10 lakhs. Now out of these 10 lakhs, there is still 1 lakh 32 remaining unpaid, which means 8 lakh 68,000 must have been paid. So if I go to see, maybe 8 lakh 68,000 would be the tax paid, and hence if I consider all items done, this is what, just let me just verify if there is anything else remaining in the balance sheet. No, I guess all items ideally should be done. 1720, 6 lakhs minus 1 lakh 20 plus 1668 minus 868 comes to, I guess, 30 lakhs cash flow from operations, CFO. In CFI, a negative value to the tune of 28 lakh 80 and 3 lakh 60, that is around 25 lakh 20. I'm not sure whether I've taken all effects correctly or not. I've just scraped through and done a basic working. So this is, let me just verify this once. Maybe the working capital adjustments I've done here or there. Just a second. Yes, okay, so this is what, 30 lakhs, perfect. 30 lakhs. Oh, I missed the purchase of land. Land I recorded, I did not really write this over here. Land purchase. So this is what, minus 4 lakh 80, the purchase of land. So this is what, 25 lakh 20 and 4 lakh 80, that is 30 lakhs. Wow. So all the money that you have generated in operations is kind of invested, and hence the only net change, as you can see, of 1 lakh 20 is the cash flow from financing. This is equal to your net changes of 1 lakh 20, against which your opening balance was 6 lakhs, and hence your closing balance comes to 7 lakh 20. You have to be very fortunate even at CA Inter to get a question like this on cash flow, let alone CA final. So I don't really think that you will get a question as simple as this. If you do, thank you stars for that. So that takes care of question number 10. Next we go to question number 11. Okay, this is the solution. We'll go to the question. Chalo, let us go to question number 11. This is on Ind AS 105. Now this is a slightly interesting question. It has impact of a particular appendix which is not discussed at length in your at least main study material of Ind AS 105. What does Ind AS 105 say? Ind AS 105 says that a non-current asset or a disposal group which is held for sale has to be recorded at the lower of the carrying value or the fair value less cost to sell. Fair value over here can be determined using Ind AS 113 principles as well, and cost to sell is the expenses that you will have to incur in order to sell the asset. Now typically it is likely that when you classify something as held for sale, it should be likely that it is sold within a period of 12 months. and hence the effect of time is usually not material. However, there is an appendix B to Ind AS 105 which outlines certain circumstances where it is possible that there are certain factors which are beyond your control, and because of this it is likely that the time horizon might stretch beyond 12 months. If the management is committed to the sale plan and if the delay is happening due to factors beyond your control, then you can still classify it as held for sale. This is one of the exceptions given under Ind AS 105, for which elaborate guidance is given under the appendix. I think appendix B to Ind AS 105. Now, one of the examples of this can be that, let us say you have committed to sell. Now you are expecting that the moment a firm commitment or a buyer is identified, there will be certain conditions which are imposed, let's say by a regulator or by a third party, which will necessarily result in a transaction which is getting delayed beyond 12 months. In which case, still you can classify this as a held for sale item, because the delay is happening due to factors which are beyond your control. Even if the buyer and the seller are ready, maybe there are some other commitments that you will have to fulfill necessarily in the type of the assets that will stretch the timelines beyond 12 months. In which case, what will you do? Well, you will recognize the effect of time as well. Like for example, the cost to sell will actually be incurred when the actual sale goes through, and if the actual sale is likely to go through after 1.5 years, after 2 years, let us say, in which case you will recognize the cost to sell at present value basis. Fair value obviously will be at the present value. Fair value, as you say, is the present value of the future cash flows. So fair value will be on a present value basis, but even the cost to sell will be cost to sell will have to be discounted if it is given that it will be spent at the time of sale, and hence you will find the value as the carrying value or fair value as cost to sell. In case you decide the fair value as cost to sell, as time passes, remember, if you have discounted it, there will be some unwinding element as well. So there will be some unwinding element that you will have to see as time passes, which will be seen in this particular problem. So that small adjustment over here is slightly important. So company X has identified one of its divisions, that is disposal group, to be sold to a prospective buyer, and the board has approved the plan to sell the division on 30th of September 20x1. So there is one of the divisions to be sold to a prospective buyer, okay, and board has approved. So appropriate level of management seems to be committed. A buyer has been identified. The sale is expected to be completed after 1 year, but it still qualifies as held for sale under appendix B to Ind AS 105. Remember, if this sentence is not given, we will not assume that it qualifies as held for sale. There has to be certain data which is given which points out that it qualifies under these exceptions. Usually these exceptions are in case the buyer and in case the entity is intending to sell, a buyer may have been identified, or we are anticipating that once a buyer is identified, if the sale goes through, maybe there's a regulator, maybe there's a third party which will impose conditions for completing the sale which will stretch beyond 12 months period, in which case you are allowed to classify something as held for sale. In the sums that are there in the study material, none of these cases are mentioned in the sense in the sums. If this line is specifically mentioned in any of the study material question, then even if the time limit is beyond 12 months, we can still qualify it as held for sale, because the question specifically tells you that based on the facts and circumstances of a particular case. Now, cost to sell of the division are estimated to be 10 crores, okay, which is to be incurred in March 20x3. Well, when do you classify something as held for sale? On 30th of September 20x1, and it is likely that the sale will go beyond 12 months. Maybe it will be completed by 31st March 20x3, that is after I think 1.5 years or 18 months, and that is when 10 crores will be incurred. The fair value of the division is 400 crores as on 30th September 20x1. So fair value must be based on the present value, and hence there will be no further discounting. If 10 crores were also the cost to sell on 30th September, there would be no discounting, but the question tells you very clearly that these are the 10 crores which will be incurred on 31st of March 20x3, and hence present value workings are required. And on 31st March 20x2 as well, the value is 400 crores only. So the fair value remains the same. The cost to sell I think also remains the same, but the cost to sell will be at the present value, and the carrying value is 500 crores. Okay. How shall a division, that is a disposal group, be measured under Ind AS 105 on the following dates? First is 30th September 20x1, next is 31st March 20x2. Consider a discount factor at the rate of 10% for 1 year to be 0.909 and 1.5 years to be 0.867. So now if I look at question number 11, if I look at the situation on 30th of September 20x1, I will compare the carrying value, which is I think 500, with the fair value, which is 400, less the present value of the cost to sell. The cost to sell over here is 10 crore, which is to be incurred after 1.5 years, and hence the time value adjustment will be 0.867, and hence this will be at minus 8.67. So 400 minus 8.67, which will be 391.33, and hence there will be an impairment or a write-off, as the case may be, impairment or a write-off under Ind AS 105 to the extent of 108.67. If I look at the same position as on 31st of March 20x2, let us say the fair value is still 400, but now when I do the present value workings, the present value workings will be 10 into 0.909, and as a result this will come to 9.09, which means over here your value is 400 minus 9.09 comes to 390.91. So basically your asset which was appearing at 391 will now be at 390.91. Now this additional impact is due to financing, it is unwinding. So therefore there would be certain unwinding, that is basically finance cost. There would be finance cost. So instead of debiting impairment, you will debit finance cost, which can be, let us say, 8.67 into 10% into 6 by 12 for simplicity. 8.67 into 10% into 6 by 12, that is around 0.4335, or you can also calculate this as the difference between 390.91 and 391.33. So if I take the difference between the two, I think I should get almost the same answer. 391.33 minus 391.33 minus 390.91 comes to around 0.42. That is approximately the same value, 0.42 or 43. Either ways you can calculate. These are just alternative ways. This is unwinding, so you will debit the finance cost and credit, let us say, the individual items in the disposal group. So you will not debit the impairment cost. This will be finance cost, which will go to the profit and loss account to the extent of 0.42 or 43, as the case may be, to, let us say, whatever are the individual assets in the disposal group, or for that write-off to, let us say, the assets in the disposal group. We do not have any specific data regarding the same, and hence we are just crediting the disposal group for the time being. So if you go to see in question number 11, the solution to question number 11, we have been given that on 30th September 391.33, 390.91, the increase in cost, that is 0.42, will be recognized in the P&L as a finance cost in accordance with the with some relevant paragraph. Perfect. So that takes care of question number 11. Next we will go to question number 12, which is pertaining to Ind AS 2. So this is the next question on Ind AS 2. Most of the parts of these questions are easily digestible, though there is one very interesting part over here. Usually we are always trained to think that general administrative overhead, selling and distribution overheads, they will never be a part of the cost of inventory, and they will not. However, if there is certain expenses which are linked to your production, maybe you have to administer, like a supervisor for example is doing nothing but administering or reviewing whether the production is happening on time or not, or if there is any other expenses which are directly attributable to, let us say, production, then that is very clearly considered to be directly attributable to the production, and hence it will be a part of your inventory cost. So let us keep that in mind and go ahead. Remember, the general administrating overheads, like an accountant, like an auditor for example, that will not be a part. However, if administration is directly attributable, linked to the production, to manufacture, etc., that should be considered. Like administrating, reviewing, ensuring, maybe something as basic as ensuring there are CCTV cameras who are seeing whether the workers are working in order or not. That is in a way an administrative cost, but that is linked to production, and hence that should be a part of the cost of the asset. Okay, If nothing is, we assume that administrative is general administration and hence is not a part of the cost of the inventory unless it is specifically given, like in this case. Let us read this. Now, A Limited began operations in the year 21-22. In the year 21-22, it incurred the following expenditures on purchasing raw materials for its product. Okay. Purchase price of raw materials 30,000. Will that be a part of cost? Yes, 30,000 is definitely a part of cost. Import duty and other non-refundable taxes, should that be a part of cost? Yes. Refundable purchase taxes, should that be a part of cost? No, it is refundable, it is creditable, and hence it will not be a part of the cost. The freight cost for bringing the goods from the supplier's factory to the storeroom for raw materials, this is directly attributable to getting the inventory in the ready to use condition, and hence this is to be added, let us say 30,000. Cost of unloading the materials into the storeroom for raw materials, again this is loading and unloading charges, directly attributable, and hence this should also be added. It is just 20 rupees, but still it should be considered. Packaging cost, unless given otherwise, this is also directly attributable and hence should be added. On 31st March 20X2, A Limited received a 530 volume rebate from a supplier for purchasing more than 15,000 from the supplier during the year. This is like a volume rebate, which is a trade discount. Trade discount should be subtracted and hence less 530. Okay, A incurred the following additional cost in the production. So over here, if I go to see for the raw materials 38 and 3, this is I think 41,000, 41,000 plus 20 plus 2,000 minus 530. This comes to 43,000, just a second. 38 and 3, 41 plus 20 rupees plus 2000 rupees minus 530 rupees, 42,490 will be your raw material cost, which is going for your final product. A incurred the following cost in the production run. Salary of machine workers in the factory, should that be added? Definitely 5,000 should be added. Salary of factory supervisor, yes, directly attributable. Direct labor should be added. Depreciation on the factory building and equipment used in the production process. Now, we have even discussed this in class where a lot of students say, sir, how can depreciation be a part of the cost of the inventory? Why not? Remember, we are not preparing the cash flow statement or we are not doing capital budgeting. We are doing books of accounts, and in books of accounts, whether you prepare the cost sheet, whether you prepare the manufacturing account, depreciation is very much a part of the cost of the item, and as a result depreciation is a part of manufacturing cost, depreciation on factory is a part of cost sheet as well, and hence it is very much a part of the cost. So this is depreciation on factory building and hence this should be added, 600 should be added. Consumables used in the production process, so this can be shown separately as well. Otherwise you can show the consumables as a part of the total conversion cost, 200. Depreciation of vehicles used to transport the goods from the storeroom for raw material to the machine floor, again this is directly attributable to construct the asset, and hence this 400 worth of depreciation should also be attributed to the inventory. Remember, this vehicle might have a total depreciation of, let us say, 4,000. Out of this 4,000, 400 is attributable to inventory manufacture, and hence this 400 will be added along with the inventory cost. The remaining, we don't know how much is the depreciation. The remaining depreciation, if any, will go to the profit and loss account. Factory electricity usage, so this is for factory, will be added. Factory rental, again for factory should be added. Depreciation of the entity's vehicles used by the factory supervisor, again this is for the purpose of the supervisor, and hence this will be also added. So if I consider all of these as well, this will be what, 5,000, 8,600 and 600 and 1,300 and 200. So this is 10,700. This is 10,700. During the year 11-12, A incurred the following administrative expenses. During the year 11-12, A incurred the following administrative expenses. Depreciation of the administration building. But this is administrative expenses. Ideally, they should go to the P&L account. Okay, perfect. They should go to the P&L account. Depreciation of admin building is 500. Depreciation and maintenance of vehicles used in the administration by the admin staff, this is 150, and salaries of administrative personnel, this is 3050. They should ideally go to the P&L. Now comes the slightly problematic sentence. Of this administrative expense, 20% is attributable to administrating the factory. This sentence has not been mentioned in any other place generally in your study material, and hence administrative cost, if nothing was given, would have gone to the P&L only. However, if it is clearly given that 20% of this cost is attributable to administrating the factory, it is directly attributable and hence it should be added. So over here, even if you have seen certain of your clients, you would have seen that in a lot of your clients there would be certain expenses which are incurred at the stage of even PP, where you have capital work in progress, where there are certain administrative expenses while constructing a site. If they are directly attributable to that site construction, they are added. However, if they are general administrative expenses, they will not be added. So over here, if I take the total, that is 500 plus 150 plus 3050. That is, if you take what 500, 150, 3050, total comes to I think 3700. Will I add the entire 3700? No. I will add 3700 into 20%, which is towards administering the factory. Ideally, we would not take this unless that sentence that I've highlighted was not given. Remaining expenses are attributable in equal proportion to the sales and other non-production related operations like finance, corporate tax and secretarial functions. So for that 80% will go to the P&L. In the year 11-12, A incurred the following selling expenses: advertising cost, this will go to the P&L. Depreciation for vehicles used by the sales staff, again going to the P&L. Salaries of administrative personnel, general administrative unless otherwise given, also going to the profit and loss. Okay, just a second. Pass the necessary journal entries to record the cost of the inventory in the books of A. Now, you can pass the entry. Otherwise, what I will try to do is, I will try to find the overall cost 1, 2 and 3. So if I take 42,490 plus 10,700 plus 740, this comes to 53,950. This is your total cost, 53,950. This is your total cost of all inventory items put together. If I were to pass a journal entry, wherever the expense is a cash payment like unloading, packaging charges, purchase, the entry will be to cash bank. Wherever there is a depreciation, ideally it is depreciation to PP and then P&L to depreciation. Instead of P&L to depreciation, there will be inventory to depreciation. So your entry will essentially be, in general, inventory account debit to cash bank to depreciation. Whatever is the depreciation, we have not really paid it, but it will be a part of the cost. The total coming up to around 53,950. So if we kind of just verify that, and you can just refer the entry as well at the end, but 53,000. So this is 42,490 for the purchase. So this is for 53,930. That is your total cost of inventory all put together. We have considered everything else separately as well. So the only point that needs some, 2 points that need some bit of detailed understanding on your side would be to understand that depreciation can very well be a part of the cost of the asset. This is based on the generally accepted accounting practices, cost accounting practices as well. Secondly, and you can see that in manufacturing and trading account, you can even see that in cost sheet, and in general we have done sums in PP as well as in inventory where there is directly attributable depreciation for constructing either a PP or inventory. That depreciation should be added to the cost. And secondly, administrative expenses usually should not be added to the cost of the inventory or the asset. However, if they are directly attributable to, let us say, construction of the inventory, then they should be added. Because of this sentence which we have highlighted, we have added this. If this sentence was not there, definitely administrative expenses would have gone to the profit and loss account only. It is like people who are running security of your factory. That is, they are not on the manufacturing floor. Security staff of your factory or the CCTV, they are administrative in nature, but they are directly attributable to your inventory. If, let us say, you are running a business which is as sensitive, let us say, as a diamond manufacturing business or a diamond cutting business, in which case, yes, there will be the machine or the floor workers who are actually cutting the diamond. However, there has to be really strong security that is administrative in nature. However, that is directly attributable in the increasing the cost of the process because of the high degree of security needed for that operation, for example. Okay. Next, you have Ind AS 40 and Ind AS 60. Now, this is a question which is from a GFRS material. I would rate this as important. Kind of guides you on classifying a particular item as a PP or as an investment property. The question seems to be fairly big. However, that is, in my opinion, most of these are fairly easy interpretations. When is a particular item investment property? If it is land or it is building which is either owned by the entity or taken on lease with the primary intention of earning rental income or capital appreciation or both. but not for the purpose of own use or held for sale in the ordinary course of business. A few special cases, like if the property remains vacant at the time of initial recognition, if the property is vacant at the time of initial recognition, you look at the intended use. If the intended use is to use for your own business, it is PP. If the intended use is to give it out on rent, it is investment property. If it is undetermined, it we treat it as investment property. Secondly, if the property is used for dual purposes, then the law over here is, if it is used for dual purposes, the part which is attributable to your own use, and if it is separable, it is PP, and the other part, if it is separable, is investment property. If you cannot separate it out, the entire item is treated as a PP only, unless the own use part is insignificant. And the third part over here would be that in case you have something like an employee staff quarters. An employee staff quarters is typically primarily for the purpose of employee welfare, and hence it is treated to be for own use, and hence even though I am earning rental income, that is not my primary objective, and hence we treat this as a PP, typically employee staff quarters. Keeping that in mind, let us refer the theory for question number 13. Now, besides manufacturing plants, A Limited has various other assets not used for operating activities. For example, freehold land, townships in different locations, excess office space, etc. Now, A Limited has some land which is kept vacant as per government regulations, which require a specific area around the plant should be kept vacant. So, this is just general discussion. The details of these assets are, so one by one we'll give a separate classification. What do we need to do at the end? If you see, determine the classification of properties which are not held for operational purposes with suitable reasoning in the financial statements of A Limited. Okay, let us refer this. Now, A Limited's office building, which is its registered office basically. A Limited's registered office in Delhi is a 15-story building, out of which only 3 floors are occupied by A, whereas the remaining floors are on rent to other companies. The agreements are usually for a period of 3 years. Accordingly, according to A, such excess office space will continue to be let out on lease to external parties and has no plan to occupy this in the near future. Now, what do you guys think? Well, over here are the first 3 floors and the next 12 floors. For example, just a second, I'll just get the connection secure. Okay, are the first 3 floors and the next 12 floors separable? Yes, and hence the first 3 floors will be treated as PP, whereas the next 12 floors are treated as investment property. Flats in a township located in location 1. Again, each flat, strictly speaking, is separable. As regards to a township in location 1, there are approximately 2000 flats in the said township. It was built primarily for A's employees, and hence approximately 80% of the flats are allotted to employees, and remaining flats are either kept vacant or given on rent to other external parties. So basically, this 80% of the flats without any doubt will go in the PP section. Remember, the 80% of the flats and the remaining 20% are separable, and hence for the remaining 20%, it depends on your intention. At the initial classification, what is your intention? Is your intention to give it to your employees ultimately, or is your intention to earn rental income and give it on rent to external? If it is to give it on rent to employees only, then the classification for these 20% will also be PP. Or if it is to earn a rental income for this remaining 20%, then it will be investment property. A lease agreement is signed between A and an individual party for every 12 months from 1st April to 31st March. The lease entered is a cancelable lease, cancelable at the option of any parties. Also, besides monthly rent, additional charges are levied by A on account of electricity, water, cable connection, etc. Though these are treated to be insignificant, primarily it is rent. According to A, there is no intention of selling these excess flats or allotting it to its employees, in which case it is more likely that you can treat this as an investment property, the remaining 20%, considering they are separable. Flats in township located in another location, location 2, there are 1000 flats in location 2 township, of which 400 flats are given to employees for their accommodation. This will clearly be PP. 350 flats are given on rent to central government and state government for accommodation of their employees. The average lease period being 12 months with cancelable lease. It does not really matter whether you give it to central government employees or any employees. Well, they would be investment property if they are not your employees. And 250 flats are kept vacant. Now, vacant depends on your intention. Again, you have to see that what do you intend to do with the vacant flats. If you intend to give it to your employees, this will be classified as PP. And in other cases, intended to be given on rent to other employees, or if it is intended that the use is undetermined, in all other cases we treat it as investment property. Now there's a hostel. It's a fairly rich company. It has a lot of properties. Hostel located in location 1. 60 rooms in the hostel have been let out to G Limited to give accommodation to their personnel. Now G has no connection with the entity, so it's a separate entity altogether. This agreement is prepared for every 11 months and renewed thereafter. Besides monthly rent, some charges are levied towards water, electricity, amenities, that is cable connection. Again, this is very clearly an investment property. No two thoughts about it. You are given it on rent to G, X, Y, Z, it does not really matter. For 11 months, 24 months, 11 years, it does not really matter. Land in location 1. So we are just saying that unless given otherwise, these are all operating leases. They are not finance leases, because if you give it out as a finance lease, the asset will not even appear in your books. Land in location 1. In 20x4, A Limited purchased a plot of land on the outskirts of a major city. The area has mainly low-cost public housing and has very limited public transport facilities. Okay, the government plans to develop the area as an industrial park in 5 years, and the land is expected to greatly appreciate in value if the government actually proceeds with the plan. So it seems that you have acquired this for the purpose of capital appreciation. He has not decided what to do with the property. A very clear investment property classification, because it is land which is held for the purpose of capital appreciation, not for your own use. And even if you say that the use is undetermined, it goes under investment property. Land in location 1 again, and land in location 2. A portion of the land has been leased out to C for its manufacturing operations. Land has been given on lease on a lease rental of 10 lakhs with a lease term of 25 years. So be it, let it go to C Limited. We are A Limited. We are not using it for your own use. No sir, but C Limited is using it for its own use. How does it matter? Your classification is PP if you use it for your own use. If you give it on rent and someone else is using it for their business, that does not make it PP for you. It is ROU PP for them, not for you. For you, it will continue to be shown as investment property because you are primarily intending to earn a rental income. A portion of the land has been given on rent to D, which has constructed a petrol pump on such land. It has been leased for a period of 40 years and renewed for another period of 40 years. Again, this is going to be investment property only. The appropriate classification in both of these cases is going to be an investment property classification. Okay, so that takes care of question number 13. The next question is question number 14. Now, this is very similar to two slightly problematic situations which arise in case of a joint operation if a co-venturer transfers assets to the joint operation. The rule that one needs to remember is when, let us say, a partner transfers their assets to a joint operation, not a joint venture. Joint venture is treated to be a separate entity where we just show an investment. Joint operation is a situation where there is either no separate legal entity, or even if there is a separate legal entity, there is a direct interest in the assets or liabilities, or the partners directly take output, in which case it is a joint operation, in which case proportionate consolidation applies. So if I am a partner A who owns an asset which is, let us say, worth 100 rupees, and if I give that asset to the joint venture, implicitly it appears that I have sold the asset. No, I have not sold the asset. Proportionate consolidation necessitates that 50%, if 50% is my share of the asset, is continued to remain in my book. So what am I selling? Am I selling the entire asset? No, I'm selling 50% of the share in the asset to the other partner. So it is as if the transaction is treated as if the entity, when it transfers the asset to the joint operation, it is not selling the entire asset, it is merely selling that part of the asset which is attributable to the other partner's share, because proportionate consolidation will necessitate that the initial part will continue in the entity's books. Or if there are two parties to a joint venture or a joint operation, 50-50, the other party transfers the asset to the joint operation, we say, how does it matter to us? Well, it does matter, because proportionate consolidation will result in 50% of that asset coming to me. So basically what I am doing, if some other party is transferring asset to the joint operation, is I am purchasing 50% pro rata, proportionate share of the asset from the other party. So this is how your entries are going to flow. So let us, there are a couple of sums which are there in your joint venture chapter for this. I think question 21 and 22, you can refer that for much more detailed guidance, but otherwise we'll just quickly review this. Entities A and B establish a 50-50 joint operation. The question very clearly tells you it is a joint operation in the form of a separate entity. There may be a separate entity, but it is classified as a joint operation as given in the question. Entity J, whereby each operator has 50% ownership interest and it takes 50% of the output. This is probably why it is classified as a joint operation, because exclusively all the output is going to be enjoyed by the two parties. So there's a direct interest that the parties have. On the formation of the joint operation, A contributes a property with a fair value of 110 lakhs and intangible assets with a fair value of 10 lakhs, whereas B contributes equipment with a fair value of 120 lakhs. So A is giving property as well as intangible, and B is giving some equipment which is worth 120 lakhs. Okay, these are fair values. This is entirely giving you data regarding fair values. The carrying amounts of these assets contributed by A and B are 100 lakhs and 80 lakhs respectively. Now, if nothing is given, this 100 lakhs which is contributed by A is assumed to be the total carrying value of the property and the intangible asset, whereas B is just giving only one thing, that is equipment. So this is the value of the equipment that B gives. What will be the amount of any gain or loss to be recognized by A and B in their separate as well as in their consolidated statements? Remember, we are doing proportionate consolidation over here. So if we were to pass the entries, let us say in the books of A, debit what comes in, credit what goes out. What is coming in, what is going out? Well, if I look at question number, what was this? I think question number 14. If I look at question number 14, if I'm in the books of A, debit what comes in, credit what goes out. What is coming in? Equipment is coming in. Sir, how is equipment coming in? Well, B is giving the equipment to the joint operation, and when B gives the equipment to the joint operation, I will get, let us say, 50% of the equipment. At what value? Well, at fair value. We don't care what the value will be in the books of B. B is giving equipment which is worth a fair value of 120 lakhs. So this is debit what comes in, 120 into 50%. This comes to, let us say, 60. However, what are we paying in that return? Well, we are paying property, we are giving up property, and we are giving up intangibles. Now, this property and intangibles have a total carrying value. Remember, when you are giving up something, you credit what is the WDV. Sir, we are giving up something which is worth 100. But we are not selling the entire asset. 50% of the asset is retained with us, and hence the remaining 50% is transferred, and hence this will be credited at 50, and hence there would be a gain in this process which will go to my P&L, which is worth 10 rupees in the books of A. There is an alternative treatment also given. This treatment is given by the institute in the suggested solution. They have also given an alternative treatment, but I guess this should suffice because this is one of the alternative treatments and this is logical. What I want you to do is, I want you to try for B on your own. You ask yourself, debit what comes in, credit what goes out. What is coming in will be at the fair value, but what is going out is going to go out at the proportionate carrying value. What comes in, that is the proportionate fair value. You are acquiring some asset, so you will have to pay the fair value. But when you are giving up, yes, you are kind of mentioning that, think of it this way, if there is a land of 100 which I sell at 500, bank account debit will be at 500. That is what consideration I get, but what I credit is only the land worth 100, what is there in my ledger. Otherwise my ledger will show a negative balance. And hence for B, debit what comes in, what is coming in? Well, property. Sir, how is B acquiring property? Well, the property is going to the joint operation, and joint operation ka 50% interest is with B. So property has a fair value, if I am not wrong, of 100 into 50%. Even intangibles. So intangibles have a fair value of, I think, 10. I don't remember it precisely, but I think it is 10. So this is intangibles. Let me just verify this once. No, property is fair value of 110. Intangibles is the fair value of. So this is, sorry. Yeah, sorry. So over here, when we look at your property, the property I guess is 110, the fair value, and intangible is 10. So you are acquiring property from A, which is worth 110 into 50%, that comes to 55, and intangible which is worth 5. In return, you are giving up your equipment, and your equipment may be worth 120, but what is it worth in your books? Well, in my books, it is worth at 80. It is like saying that if I had sold the entire equipment of 80 at 120, I would have recognized the 40 rupees gain. Now I'm selling an equipment of, or half of the equipment, which is worth 80, so 80 into 50%, and getting a consideration of, let us say, 55 plus 5, that is equal to 60. And as a result, this is a gain on sale. So this is a gain on sale which is coming at, I think 20 rupees, which will go in your profit and loss account. This is where the institute kind of ends, and even in the study material questions, they have kind of done this adjustment for unrealized profit, which you can, if you want to do separately. However, if just a gain or loss to be recognized is asked, this should kind of suffice. Okay, the next question over here is Ind AS 36 question. It is exactly the same question as what was there in one of the recent, I think, RTP of May 21, as well as I think this is also there in the study in our books at question number 31. You would have done this. It is definitely an important question. I'll just give you a quick overview of this question, and then we can jump on to the next question directly. So this is a question which involves the goodwill and in case of multiple cash generating units and two-tier impairment testing. So there is some grossing up provisions which were also there in the consolidation question that we did earlier. So let us quickly review this. RTP May 21, similar to question 31 of our books. So let's review this. On 31st March 20X1, Jackson purchased an 80% of equity of Kaplan for 190 billion. So this is your PC. The fair values of the net assets of Kaplan that were included in the consolidated balance sheet of Jackson as on 31st March were measured at 200 million. Okay, so this is your net assets at their fair values. It is a group policy to value the NCI at the date of acquisition at its proportionate share of the net assets. So NCI using proportionate net assets. So if I had to calculate the goodwill on 31st March 20X1, you can calculate this as PC plus NCI less net assets. So your PC, I guess, was 190 for an 80% stake. Net assets, I think, were 200. And if I were to calculate the NCI will be 200 into, let us say, 20%, comes to, I guess, 40. And hence your goodwill, which is basically partial goodwill, I think, which will come to 30. This is attributable to the 80% stake. On 31st March 20X4, that is 3 years later, Jackson carried out its annual review of goodwill on impairment on consolidation for evidence of impairment. No impairment has been evident in the reviews carried out in the earlier 2 years. The review involved allocating the assets of Kaplan into 3 cash generating units and computing the value in use of each unit. The carrying value of the individual units before any impairment adjustments are given below. So this is before any impairment adjustment. This is intangibles, property, plant and equipment, current assets and the value in use. Ideally, to this, goodwill should also be allocated. The goodwill of 30 has to be allocated to these 3 CGUs if it is allocable. The question says it was not possible to meaningfully allocate the goodwill on consolidation to the individual cash generating units, but all other net assets of Kaplan are allocated as in the table below, which means the question involves an unallocable goodwill. So you will have to do 2-tier impairment testing, first for the individual assets, where if you compare the total carrying value with the recoverable value, which is the value in use. Let us say if I were to find the impairment, this is 170 carrying value and the value in use is 180. There is no impairment in unit A. In unit B, there is 90 minus 66, I guess a 24 rupees impairment in unit B, and there is again a 0 impairment in unit C even before the allocation of goodwill. Now this 24 has to be allocated to whom? Well, the eligible assets are intangibles as well as property, plant and equipment. Current assets are not covered by Ind AS 36, and hence ideally the impairment will be allocated between the intangibles and PP in such a way that their individual values will not go below their individual recoverable values. The intangibles of Kaplan have no ascertainable market value, but all current assets have a market value that is at least equal to their carrying value. So current assets will not bear any loss. We have not been given anything regarding PP. So PP as well as intangibles will both bear the loss. The value in use of Kaplan as a single CGU on 31st March is 350 million. This is for the purpose of larger CGU impairment testing. So this 24 will be allocated between 10 and 50. So if I look at the impairment allocation, this 24 will be allocated to the intangible assets and the property in the ratio of their carrying value. So this is 24 into 1 by 6, 24 into 5 by 6. And as a result, 24 into 1 by 6 will be 4, into 5 by 6 will be 20, and hence this is 10 minus 4 equals 6, minus 20 equals 30. And hence this will come to, let us say, 66 now. Okay. Recommend the treatment of impairment of goodwill. So if I go to question number 15, in this question, what are we supposed to do? Well, we have done the smaller impairment testing. So when I look at the larger CGU, that is Kaplan as a whole, the larger CGU, this is Kaplan as a whole, you will first calculate the carrying value. Carrying value comprises of unit A, unit B as well as unit C. Now, if I look at unit A, the carrying value, I guess, is the same, 170. Unit B is now 66 rupees after impairment, and unit C is still 100. All of these are 100%. Apart from that, there is goodwill. Goodwill over here is your partial goodwill. So if you look at the partial goodwill in this particular case, so the goodwill over here will be attributable to 80% goodwill. So the partial goodwill which is attributable to 80% stake is calculated as 30. Now one needs to remember that when we are calculating the recoverable value, that is for the entire business, and hence there would be certain unrecognized goodwill as well which is attributable to 20% stake. So if 30 is attributable to 80%, then for 20% it will be how much? So if I do this cross multiplication, 30 divided by 0.8 into 0.2 will come to, I think, 7.5, and hence the total 100% of the goodwill will come to 37.5, and hence the total carrying value, if you go to see, is 170 plus 66 plus 100 plus 37.5. So this comes to, I think, 373.5. Compare this with the recoverable value. The recoverable value will be 350, and hence there would be an impairment. The impairment over here would be around 23.5. This will be the impairment, 23.5. Now to whom will this impairment will first be allocated? So the allocation of this impairment will first go towards the goodwill. So out of the 23.5, you will first allocate this towards goodwill. What is the total goodwill? Remember, this 23.5 comes out of 373.5, and in 373.5, 37.5 is included. So the entire 23.5 is attributable to the 37.5 of goodwill. Again, this 23.5 is attributable to the parent, that is Kaplan, to the extent of 80%. So this is 23.5 into 80%. This is 18.8, and the remaining is attributable to NCI. Now one needs to remember that NCI ke liye we have not even recorded the goodwill. So there cannot be any impairment on an asset if the asset itself is not in existence, and hence the 4.7 will not be recognized, that is in partial goodwill, because the goodwill pertaining to that is not recognized. So if 7.5 of goodwill was recognized in the books, then out of the 7.5, yes, 4.7 would have been the impairment. However, that has not been recorded, and hence this 4.7 will not be recorded. So your only impairment will be 18.8, as we have discussed earlier. So your overall goodwill will be 30 minus 18.8, and post this impairment, your goodwill will probably appear at 11.2. This is regarding question number 15. I believe that you would have done this earlier. If not, you should do this. It was a very important question in the respective RTP as well as in the study material. Next, you go to question number 16. This is on Ind AS 19. Again, this question is very similar to one question that had come in RTP November 18. Multiple such questions in the study material, as well as the all important, if I'm not wrong, question number 16 in our books as well. So nothing different, just that they have just given bullet points. We'll just quickly refer this and discuss. Arunachalam operates a defined benefit retirement plan for its current and former employees. Given the large size of the company, it is engaging actuaries for advice regarding contribution levels and overall liabilities to pay benefits. General thing. On 1st April 20X1, that is the starting of the year, actuarial valuation for the present value of the defined benefit obligation was 15 crores. So if I go to see the liabilities on one side, let us say the assets, for simplicity on the other side, your opening liability was around 15 crores. On the same date, the fair value of the assets, let us say the opening value of the assets, I guess, was also 13 crores. On 1st April, the annual market based yield of the bonds was 5%. So there would be some expected interest that is getting recorded. So if I look at the PNL, if I look at the OCI over here as well in rough, this is at 5%. So 5% interest on the liability at the rate 5%, I guess, would be 15 into 5% is 0.75. This will go in the PNL in the form of interest, let us say, on the liability, which is 0.75. At the same time, there will be an expected return on the plan assets. This is 13 into 5% will again come to 0.65. This will be 0.65 and additional. So over here, this is minus 0.65, and hence a net 0.1 should be covered. During the year ended 31st March 12, Arunachalam made contributions of 1.75 crores to the plan. So this will increase the plan asset contributions of 1.75 crores, and plan paid out benefits of 1.05. So this is benefits. From where will you pay the benefits? Well, out of plan assets. So this is minus 1.05, and this will also reduce the liability. Minus the benefits paid of 1.05, this will reduce it. Assume that both these payments were made on 31st March. This is important, because then there will be no separate interest on these contributions or benefits. Otherwise, we would have to do some time value adjustments for returns on these items as well. The actuarial firm estimated that the current service cost for the year ended would be 1.55. So this is CSC of 1.55, increases a liability. This will even go to the PNL of 1.55. On 20th of February, the rules of the plan were amended with retrospective effect, which led to an increase in the present value of defined benefit obligations by 37.5 lakhs. Now, strictly speaking, this is past service cost, and past service cost has to increase the liability value and go entirely to the P&L account. Strictly speaking, there should be a 1 month unwinding, because this is happening on 20th of February. But in the RTP November 18 question, the study material question, as well as over here, they ignore this change on 20th of February. They treat it as if it is happening on 31st March as well, though you can even do a 1 month interest adjustment on this. Institute ignores this 37.5 lakhs. Again, this is lakhs, and hence this is 0.375. PSC, we are doing everything in crores, so this is 37.5, this is 0.375. During the year ended 31st March 12, Arunachalam was in negotiations with employee representatives regarding planned redundancies. This is like termination or curtailments. These negotiations were completed shortly before the year end, and the redundancy packages were also agreed. The impact of these redundancies was to reduce the present value of the defined benefit obligation by 2 crores. Okay, so your liability will be reduced by 2 crores, liability debit 2 crores. Before 31st March, Arunachalam made payments of 1.875. So this would have gone out of the plan assets, 1.875. However, the liability reduces 2 crores, but you're not paying 2 crores, which means there's a gain on curtailment. Affected by the redundancies, in compensation of the curtailment of their benefits, payments were made out of the assets, and hence there would be a gain, which is balancing figure 2 minus 1.875 comes to approximately 0.125. This will reduce your expense. So this is basically, let us say, a gain on curtailment of 0.125. Apart from that, your liability on curtailment will be reduced. Let us say if I just reduce this by 2, plan assets, curtailment. I'm just doing this in rough because we have already covered this at length earlier as well. This is, I think, 1.875, and that's it. On 31st March 12, the present value of defined benefit obligation was 17 and the fair value of the plan assets was 14. So this will help you probably in calculating whether there is any actuarial gains or losses or not. So if I look at the closing balance over here is 17 crores, and hence if there is a balancing figure, that is actuarial gains or losses. So this is 15 and 0.75 minus 1.05 plus 1.55 plus 0.375 minus 2. So ideally this is 14.625. However, this is coming at 17, and hence the actuary has changed its assumptions to the extent of 2.375. So this is remeasurement reserve. This will be actuarial gains or losses. On the liability component, this increases by 2.375. This is a debit on the remeasurement reserve. Similarly, on the plan assets, your closing probably is around 14 crores. If I take the total in all of these, this is 13.65, 1.75 minus 1.05 minus 1.875. Your closing ideally is 12.475, but it is coming as 14, which means there is 1.525, which is changes in return on plan assets, and this will debit, increase the plan assets, and hence it will credit the OCI. So this is changes in return on the plan assets, which will come to 1.525, let us say credit, and hence if I now take everything, 0.1, 1.55 plus 0.375 minus 0.125, it's a net 1.9 going in the PNL, and 2.375 minus 1.525, a net 0.85 going in the OCI as a debit in the remeasurement reserve, and 17 minus 14, that is a net 3 appearing as a net benefit. I hope you have been able to follow this. If I just quickly review question number 16 over here, if I review this just for a clear understanding. So there are multiple formats that they've mentioned. We look at this alternative format, which is preferable. So if we look at this is in loss, so this is 237.5 and 152.5. We have got 2.375 and 1.525 in crores. So this is the same working. So this takes care of question number 16. Though an important question, not a new one. Same goes with question number 17, Ind AS 115, our favorite revenue recognition standard. Again, a similar question which is on volume rebate, variable consideration remaining constrained or not constrained, similar to I think question number 22 of the books as well as the one in study material. So let us quickly review this. On 1st April 2021, X enters into contact with Y to sell mobile chargers at 100 rupees per charger. Okay, so this is a contract of sale. As per the terms of the contract, if Y purchases more than 1000 chargers until March of 2022, then the price per charger will be retrospectively reduced to 90, which means there is a volume discount. There is a variable element of how much? The variable element, remember, is 10. 90 plus 10 is equal to 100. Even if the quantity is more than 100, 90 has to be received. But what about the additional 10? Well, additional 10 will be received if the quantity is less than 1000. If it is more than 1000, then the additional 10 will not be received, and hence there is a variable consideration to the extent of that 10 amount. Till September of 2011, entity X sold 95 chargers to entity Y. So in the first 6 months, you barely sold 95 chargers, and X estimates that Y's purchases by March will not exceed the threshold of 1000 chargers. So as a result, in the first 6 months, we will believe that if I've received 100 rupees on the charger, the additional 10 will not have to be refunded back, and hence the revenue will be taken as 100. The 10 rupees over here is not constrained. So for the first 6 months, till 30th of September 20x1, ideally your revenue should be 95 into 100, which comes to 9500. In October 20x1, Y acquires another entity C, and from October to December, entity sells an additional 600 chargers to entity Y, additional 600 over and above the first 95 sold. Due to these developments, entity X estimates that the purchase of Y will exceed 1000 threshold for the period, and therefore it will be required to retrospectively reduce the price to 90, and hence now we can say that the variable consideration is constrained. So over here, variable consideration constraint. In the first case there is no constraint, in the second case now we believe there is a constraint, and as a result, now till December, if I go to see, it should be 695 into 90. So if I go to see, the revenue should be tilted 695 into 90, that is 62,550 less whatever has been earlier recorded. If I want to find a revenue in the next quarter, whatever is earlier recorded is 9500 minus 9500, and hence 53,050 should be the revenue from October to December that needs to be recorded. Ideally we would have said, okay, let's do 600 into directly 90, that is 54,000. That would have been correct. However, what about the excess revenue that has been booked in the earlier 6 months? Sir, should be retrospectively restated? No, it is not a change in accounting policy. It is not an error, and hence cannot be retrospectively restated. However, the effect has to be given prospectively, and hence in the current quarter you will do the adjustments. Analyze the above scenario in light of 115 and state how the revenue should be recognized. Well, in the first 6 months, revenue of 9500. In the next 3 months, revenue worth 53,050. This takes care of question number 17. Okay. I would not really put a lot of weight behind this because I'm pretty sure you would have done this earlier as well. Next, you go to question number 18. Now, this is a slightly different question when it comes to the determination of fair value. To be honest, I've written Ind AS 41, but I would say that it is more of an Ind AS 113 read with Ind AS 41 case. Ind AS 41 is on biological assets, and in case of biological assets, you record the biological assets at fair value less cost to sell. Now, how do you determine the fair value? Remember, fair value is a market-driven price. It is not entity specific, it is market specific. So over here, it is possible that the market price of a particular commodity, let us say, is 100 rupees. However, you are getting a bulk order, and as a result to that bulk order, because the market price of the commodity is 100 rupees. However, you are having a bulk order, and for that bulk order dedicatedly, you are giving the products at 95 rupees. Does that mean that the fair value is 95? The answer is no. Yes, if there are units which are earmarked dedicated for that bulk order, for that we can say that the price is 95 rupees because that is what we are going to get. However, for the other units, you cannot say that the price is 95 or even 105 for that matter, because that is not what a market participant would have ordinarily paid in general. And hence, when we determine the fair value, if there is a firm commitment, then the units which are earmarked for that firm commitment will be measured based on the value that we are going to collect from that firm commitment. But that does not mean that the other units which have no such firm commitment will be at the same price. No, they will be based on what the market participant is willing to pay. So let us review this in light of this basic discussion. Question number 18. So M. Chinnaswamy and Brothers is a company that is engaged in growing and maintaining coconut palms and selling their output in various forms. Okay. The company has a farmland having around 2 lakh coconut palms in the coastal area of Karnataka near Mangalore. Okay, so there are 2 lakh coconut palms. The fair value of each coconut palm is derived based on the average realizable price of rupees 30 per nut. That is per coconut, 30 rupees is the price. That is you are going to get on an average. Each coconut palm grows 80 nuts per annum on an average basis, which means if I look at a single palm, ideally it will give me 80 nuts per annum, and for each nut I am probably going to get 30 rupees, and hence 80 into 30 comes to probably 2,400 is the value of sales that I can generate in 1 year per palm. Remember, the valuation is not necessarily based on a per year revenue. It is strictly speaking the present value of all the future cash flows. So you will forecast the life of the tree and you will figure out how many years are remaining, take the present value of all of these to get the value of the tree today. Alternatively, there can be other valuation methods as well. The valuation method that we just discussed was the present value of future cash flows method, income approach. Alternatively, a market multiple can also be reviewed. Like if you see a lot of startups, etc., they are valued based on a multiple of their revenue. They say, okay, your value is 2 times your revenue, 3 times your revenue. In a similar way, you can value a palm alternatively. Instead of taking present value of future cash flows, you can also alternatively value based on the market approach, where you take a multiple and say that if your annual sales are, for example, 18 to 30, that is 2,400 into a multiple will be the value of a particular palm. Okay, fair enough. Each coconut palm can generate revenue for as long as 80 years. And the current palms are only 20 years old. Strictly speaking, the valuation should be based on the present value of the future 2,400 that you collect for the remaining 60 years, subtracted by the expenses, if any, that go in that collection as well, time value adjusted. The management thinks that considering the risk factors in the business, the valuation of each palm can be considered at 5 times its annual revenue. It's a revenue based valuation. It is not necessary that you have to take the present value of future cash flows if the management believes that the valuation is based on 5 times the annual revenue. So this is into 5, and hence 80 into 30 into 5. So this is 12,000 is the value today for a particular palm. And remember, a biological asset is measured based on the fair value. During August of 2005, okay, so this is during August of 2005, we don't know which year we are in, but let us say in August of 2005, Ooty Hotels Association chairman and his team visited the corporate office of the company in Mangalore. The deal was to supply tender coconuts to Ooty Hotels at an agreed price throughout the year. Okay, so this is for a specific contract. How many palms does the company have? Well, it has 2 lakh coconut palms. 12,000 is the value per palm. So ideally, the total fair value will be 12,000 into 2 lakhs. The deal was to supply tender coconuts to Ooty Hotels at an agreed price throughout the year. The agreement came into effect from 1st September 2005, whereby the company shall reserve 15,000 palms out of the 2 lakh coconut palms. So if I go to see, this is 15,000 out of the 2 lakh, that is barely around 7.5% of the total palms for OHA, and charge a concessional rate of rupees 15 per nut supplied to OHA. So I am giving this at 15. So what is a fair value? Is a fair value for all the nuts going to be based on rupees 15? The answer is no. For these 15,000 palms, yes, the valuation that will be based on 15. However, for the remaining, I think 1,85,000 palms, there is no reason why we should take this 15 rupees as a value, because there is a firm commitment, but that will affect the valuation only of the assets which are affected by the fair commitment, by that firm commitment. It does not mean that every other asset is going to be valued based on 15 merely because one transaction is happening at 15. The valuation is not entity specific. It is basically what a market participant is willing to pay, and every market participant seems to be willing to pay 30 rupees per nut, that is per fruit. OHA in turn will supply the tender coconuts to each Ooty hotel at the same price. The contract price is applicable irrespective of the ownership of the palm trees. That is, it is not an entity-specific restriction. I can keep the ownership of the palm tree. All tender coconuts of these 15,000 coconut palms are used by OHA irrespective of the agreement being effective from 1st September. Okay, so they were in any case being used by OHA. What will be the valuation of the 2 lakh coconut palms in the company's farm for the quarter ended 30th of September 2005? So ideally this 12,000 will be the value which is attributable to 1,85,000 palms. So 12,000 into 1,85,000 will come to, I guess, okay, this is a huge amount, so probably if I take this in crores, this comes to, I guess, 222 crores if I am not wrong, 222 crores. And for the remaining, I'll say, well, this is, again, these are going to grow 80, the remaining 15,000 are going to grow 18 palms per annum, but into 15. So the output of the 15,000 palms into 5, again the revenue multiple unless given otherwise will be the same. So this is 80 into 15 into 5 comes to 6,000. So the valuation over here is 6,000 for these 15,000. So maybe over here the valuation is relatively lower, into 15,000, again divide by crores. So this is, I guess, 9 crores, and hence if I total this up, this is, I think, 231 crores. We have not been given a separate cost to sell, and hence the valuation will be based on 231 crores over here for question number 18. So now we go to the last two questions which are remaining. Question 19 I would rate as important. It is a modification of a question which is already there in your study material, but it is more intense, I would say. So this is definitely important. Question 19, I would say that this is more covering an Ind AS 37 rather than Ind AS 19. So we'll kind of put Ind AS 37 over here rather than Ind AS 19. And then the last question on leases is a fairly easy and manageable question. So you're almost there. Sir, amendments, yes, we are going to discuss that as well, but they are relatively very, very manageable with comparing what you've actually gone through. So let us kind of go to question number 19 on so on 1st January 20x2, the directors of Johansson decided to terminate the production at one of the company's divisions. Okay, so this is a decision to terminate the production. Okay, so you are kind of abandoning, terminating rather than holding it for sale. Remember that as a first instant. They have decided. This decision was publicly announced on 31st of January 20x2, and the activities of the division were gradually reduced from 1st April 20x2, and the closure is expected to be completed by 30th of September 20x2. Now this gives birth to what you call as provision for restructuring. When do you create a provision for restructuring? When there is a legal or a constructive obligation, and a constructive obligation is if there is a detailed formal plan in place, which it seems to be because the board have decided, and that plan either is publicly communicated so that it gives rise to expectation in the minds of the affected parties, or it starts to be implemented. Over here the date of public implementation is public announcement is 31st of January 20x2, and I would believe that this is a date when you will show this as create a provision for restructuring. So this is the relevant date, timing. On 31st January 20x2, the directors prepared the following estimates of the financial implications of the closure. So this is what they have prepared on 31st January. First, redundancy cost, that is termination costs that you will have to pay, were initially estimated to be 2 million. Further expenditure of 8 lakhs will be necessary to retrain the employees who will be affected by the closure but remained with Johansson in different divisions. So this is retraining cost. This is a cost which is relating to ongoing operations, and Ind AS 37 says that while creating a provision for restructuring, you will create a provision only for expenses which are directly linked to closure. Remember, retraining, relocation is linked to continuance, and hence they will be recorded as and when the retraining or relocation happens. You will not create a provision for restructuring for the same. However, redundancy is a direct impact of closure, and hence that will go into the calculation. So 2 million should ideally go, 8 lakhs should be recorded as and when they are incurred. The retraining will begin early in July 2020x2, so it will be recorded in the next year. Latest estimates are that redundancy cost will be 1.9 million and the retraining cost will be 8.5. So over here, if I were to create a provision for restructuring, provision for restructuring, I will include initially 2 and then revise it to 1.9, because your provisions will be created based on your best estimates, that is your latest estimates, which will be, let us say, based on 1.9. However, the 8 lakh or 8 lakh 50 as a case may be will not be recorded till the time they are incurred. They will directly be recorded in July. Okay. Second, plant and equipment have expected carrying value at 31st March 20x2 of 8 million and have a recoverable value of 1.5 million. These estimates remain valid. Now, this is not a part of your provision for restructuring. This is not a directly attributable cost which is regarding restructuring. However, the restructuring can act as an indicator of impairment. Since you are terminating the line, this can very well be an indicator of impairment of the plant and equipment, and you might do impairment testing under Ind AS 36. This provision of restructuring was created as per Ind AS 37, mind you. Over here, you will create maybe an impairment as per Ind AS 36. So, if I look at the impairment, this is as per Ind AS 36, your impairment will be 8 minus 1.5 and hence 6.5 million will be recorded as an impairment loss in the profit and loss account. Okay. The division is under contract to supply goods to a customer for the next 3 years at a predetermined price. It will be necessary to pay compensation of rupees 6 lakhs to this customer since you are now terminating the operations. The compensation actually paid on 31st May was 5 lakh 50. Now, we don't know what the post balance sheet period, when does the post balance sheet period end. However, if you assume that the post balance sheet period ends after 31st of May 20x2, we can consider this to be an adjusting event which gives you an additional information of a possible payment which is due, which is you are under an obligation as on the balance sheet date. Remember, the contract becomes burdensome, it becomes onerous. So, there is a provision that you will create on account of an onerous or a burdensome contract, the unavoidable cost of fulfilling the contract we have not been given, or the unavoidable cost of cancelling the contract. So, we don't know the cost of fulfilling, but cancelling it is ideally 6 lakhs. So, if this was million, this was also million, this is 6 lakhs, or we can say 0.6 million, which gets reassessed to 0.55 million, assuming the financials are finalized on or after 31st May. Institute has taken that. Achha, the division will make operating losses of 3 lakhs per month in the first 3 months of 22-23 and 2 lakhs per month in the next 3 months of 22-23. The estimate proved accurate at least for the first 2 months. Will you consider that? No, you will ignore for the year 20x1, 20x2. Remember, future operating losses will be recorded as and when the losses actually happen. You will not include them as a part of the restructuring provision. The division operates from a leasehold premise. Okay, so we are operating from the leasehold premise. So we are like the lessee. Remember, here they have given a solution which is not, to be honest, in line with Ind AS 116, but it is in line with the general accounting practices, ignoring Ind AS 116 to keep it consistent with the institute solution. We are also discussing it on the same lines, though under Ind AS 116 there will be slightly different types of numbers which would be appearing in your balance sheet. The division operates from a leasehold premises. The lease is non-cancelable. Okay, operating lease. Now, how on earth is that possible? You are, remember, under Ind AS 116, if you are the lessee, there is nothing called as operating lease or finance lease. No, sir. It is in the books of lessor, yes, but you are the division who is operating from the operating lease, from the lease, and hence this should ideally be a right of use asset with a corresponding lease liability for you. Ideally, if 116 were to be followed, with an unexpired term of 5 years. So it is not even a short-term lease that you are showing separately. No, it is 5 years from 31st March 20x2. The annual lease rentals payable on 31st March in arrears are 1.5 million. Okay, the landlord is not prepared to discuss early termination payment, which means this contract also becomes a burden. It becomes onerous. It becomes a burden to you. So the cost of fulfilling would be 1.5 million to be paid in each of the 5 months. Are you going to get anything in return? Following the closure of the division, it is estimated that Johansson would be able to sublet the property from 1st October. Johansson could expect to receive a rental of 3 lakhs for the 6 months. Well, for the first 6 months, we have not been given anything, so we will ignore the same. Ideally, we should have been given what is happening in the first 6 months, and we could have considered that as well, but here nothing is given. And from 1st October to 31st March, the annual rentals would be 5 lakhs for each period starting 31st March to 31st March 17. So another, I think, 4 years, I guess. All rentals will be received in arrears, 3 or 4 years, whatever it is. So there are how many years remaining on the lease? I guess there are 5 years remaining on the lease. So again, you will have to create a provision. This time around, the provision is for an onerous contract. Onerous contract, the provision is created for the cost that is incurred to fulfill or the cost that is incurred to cancel the contract. So over here, landlord is not ready to discuss about cancellation, and hence the cost will be the cost to fulfill. Now the cost to fulfill, unavoidable cost to fulfill, is 1.5 for the next, I think, 5 years. Any discounting calculation should be performed using a discount rate of 5%. You are given the following data at 5%. Present value for 1 year, 1 to 2, 1 to 3, 1 to 4, 1 to 5. So this is 4.32. So this is 1.5 into 4.32. This is 6.48. Unavoidable cost. However, there will be some sublet income. Sublet income. This will be 0.3, which is received in the first year. This is into 0.95 plus for the remaining 4 years you will receive 0.5. This is from years 2, 3, 4 and 5. So basically you will take 4.32 minus 0.95. So if you do this working, this is what? 4.32 minus 0.95 comes to 3.37 into 0.5 M plus 0.3 into 0.95 M plus MRC. So this, I guess, is 1.97, and hence the unavoidable cost would be, I guess, 6.48 minus this. So that is 4.51. So you will create a provision for the onerous contract at 4.51 in present value terms. Compute the amounts that will be included in the statement of profit and loss for the year ended 31st March 20x2 in respect of the decision to close the division. Now, because of the decision to close the division in your P&L, there will be a provision for restructuring which is appearing at 1.9. There would be an impairment that goes at 6.5. There would be a provision on onerous contract at 0.55 and another provision at 4.51. Remember, this cannot be shown as a discontinued operation, at least in the current year, because the discontinuance actually has not happened. We cannot even show it as held for sale because you don't intend to sell it. Okay, just to be amply clear, we'll just verify this with what the institute has to say. Let us say for 19 at the end, if you see, especially for this item, there is a 4.51, that is what we got. There is 0.55. Institute is assuming that 31st May is within the post balance sheet period. Alternative solution is possible. Impairment of 6.5 is recorded and a redundancy cost of 1.9 is to be recorded. So you can refer this. It is similar to one of the questions in the RTP of November 18, which I guess we have also covered, is I think question 20 or 25, I'm not sure, of Ind AS 37, a fairly long question. And we are finally there. So this is a very easy question for Ind AS 116, where we want to figure out whether there would be a lease or not. Well, for determining whether there is a lease, there has to be an identified asset, point 1, and there should be a right to direct use. Control of use should be there, for which substantially all benefits which are linked directly or indirectly with the operation of the asset should flow to the customer or the lessee, as the case may be. Remember, benefits which are linked to ownership can very well go to the lessor, similar to I think question 7 or 8 or so of the study material as well as our notes. Entity X is a utility, enters into a contract for 20 years with entity Y, okay, a power company, to purchase all of the electricity produced by a new solar power station. So over here, from the solar power station, which is an identified asset, from the solar power station, which is basically, let us say, an identified asset, the direct benefits would be power. The power over here would be the direct benefits. To whom is the benefits going? Well, it is going exclusively to X. It enters into an arrangement to buy all of the electricity by a new solar power station. The solar power station is explicitly specified in the contract, and entity Y has no substitution right. So there is basically an identified asset. This is when we say there is an identified asset. Entity Y owns the solar power station and receives tax credit which is relating to construction and ownership. So these are benefits going to Y, but these are benefits linked to ownership, not linked to operation. and entity X will receive renewable energy credits that accrue from the use of the solar power station. So some indirect benefits which are linked to operation would be renewable energy credits. So this is energy credits which are linked to operation, which are going to X only. Whether entity X has the right to substantially obtain all of the economic benefits from the solar power station during the period of the arrangement, your answer is a clear yes. Sir, but entity Y is getting the benefits on account of tax credits relating to the construction, etc. One needs to remember that tax credits, etc. relating to construction are linked to ownership and not linked to operation, and hence Y can rightfully keep them. That will not impact your overall assessment. So that's it. That takes care of all the 20 questions of the November 2023 RTP, including the ones which are similar as well as the ones which are different. I hope this session has been helpful. But before we end over there, the first few pages of your RTP was dedicated to certain amendments. Again, the word amendments is something which kind of scares the students a lot. There have been 3 amendments, as we have even mentioned earlier. During our session, there have been 3 amendments over here. One is coming out of a notification which was given on 31st March 2023. One is on 20th of September 2022, and one is on, I think, 25th of March of 2022. For these 2 amendments, which is linked to CSR, as well as the amendments which are linked to a few other Ind AS, we have already covered a separate video. Which you can find for these amendments, you can find along with the RTP of May 2023, and here for November 2022 RTP we have given a separate video, so you can refer them. Nevertheless, I'll just give you a quick overview so that you don't have to kind of refer 10 different things if you don't have time. And these are the relatively new amendments which are covered. So what is covered in these? So there are a few standards. First is Ind AS 1. Now in Ind AS 1, earlier, if you remember your financial statements, at the end of the financial statements in your actual client place, you write significant accounting policies. Now that has been replaced by something called as material accounting policies. So like you had to give the significant accounting policies, you have to now give material accounting policies. From a student solving perspective, I don't see any material changes, at least in your FR paper. And we just have to mention which policies are material, and at the same time we have to mention also in the notes the judgments that have been used. So instead of significant accounting policies, we are using the words material accounting policies, and they have just mentioned a few things of how can you treat something as material. Well, the guidance over here is similar. Something is treated as material if it has the potential to impact the decisions that a reader of a financial statements can take. That is what is called as a material accounting policy. And along with the material accounting policies, you have to also use the judgments that are going to be used. So to be honest, that does not really have any consequence on the sums that have been done. So Ind AS 1, as we mentioned over here, instead of significant accounting policies, you have material accounting policies. They mentioned what is a material accounting policy. It is something which can reasonably be expected to influence the decision of the primary users. Now, along with that, you also have to show the judgments that the management has made in this process. So it is more of a disclosure change, nothing significant from a solving perspective. Change number 1. Change number 2 is coming in Ind AS 8. Again, under Ind AS 8, you had certain data which is given regarding changes in accounting estimates. Instead of giving changes in accounting estimates, they have now tried to define what is meant by an accounting estimate. An accounting estimate, as you kind of already know, there's no amendment, there's no change in the essence over here, is something which is a monetary amount which is linked to certain uncertainty regarding judgment, and they've given you a few examples of accounting estimates like depreciation, etc. So over here there is a definition of accounting estimate which is given, which is mentioned over here. Accounting estimates are monetary amounts in financial statements that are subjected to measurement uncertainty. So these are estimates are basically monetary amounts, as you go to see, which are subjected to certain degree of uncertainty, and that is kind of it. Nothing significant I would put my weight behind. A few additional examples have been added. The existing examples have been removed. A few examples that have been added, which in my sense you would have known even irrespective of whether they were mentioned in the standard or not. Like a loss allowance under Ind AS 109, the expected credit loss, it is linked to an estimate. The NRV, net realizable value of an inventory, that is linked to an accounting estimate. The fair value of an asset or liability appearing as per Ind AS 113, especially if you are looking at level 2 or level 3 indicators. The depreciation expense in case of a PP, again the change in the method of depreciation, even the useful life, salvage, all of these are accounting estimates, and a provision for warranty under Ind AS 37. So these are a few examples of accounting estimate changes which you would have irrespective treated as accounting estimates only. None of these are accounting policies per se. NRV, fair value, depreciation, all of these are accounting estimates. Next you have something regarding Ind AS 12 and then a corresponding impact under Ind AS 101. Now what does this mention? Now Ind AS 12 has added an exception over here that in case there are certain items where if I look at both assets and liabilities, like when we look at an ROU asset and we look at the lease liability, if I want to calculate a deferred tax calculation over here, the amount of the ROU asset, at least at initial, and the lease liability is the same. In which case you may, if you want to, not create a separate deferred tax asset or a deferred tax liability. This is an exception which is added under Ind AS 12. Having said that, when you do Ind AS 101 at the stage of first time adoption, if at the stage of first time adoption there is an asset and a liability, an ROU asset and lease liability, or a site restoration provision and the corresponding PP, the standard says you should at the time of first time adoption continue to create a deferred tax even if there is an exception. So basically there is an exception which is provided over here which permits you from not creating, because they think that the effects will be offset, not creating DTL/DTA for exactly same temporary and deductible as well as temporary differences. The classic example you can think of this would be an ROU asset and lease liability, not creating a DTL or DTA for similar meaning offsetting, rather, for similar into bracket offsetting taxable and deductible temporary differences, in short. So if I go to see over here, as per the amendment, a paragraph 15 and 24 has been modified by adding an exception to the recognition of deferred tax liability or deferred tax asset on taxable, on which items? On taxable temporary differences or deductible temporary differences respectively, arising on account of an initial recognition of an asset or liability in a transaction which at the time of the transaction does not give rise to an equal taxable or deductible temporary difference. So over here an exception is provided, and hence if you don't want to create because they are offsetting, then you might skip the deferred tax asset and liability creation. Now 101, again this is, if you are even doing 101, that is kind of a pat on your back. A lot of students kind of leave 101. This is a very granular area in 101, where 101 sometimes in case where you have to create on the first time adoption as per Ind AS a lease liability and an ROU asset, or at the same time provision for site restoration and a corresponding adjustment to PP, one can always argue and say that okay, these are items where deferred tax will get offsetted. However, the exception added above will not apply. Just a very granular and a fine minute case which is very unlikely in your exams. Exception added above will not apply to DTL/DTA to be created at first time adoption only in two cases. In case of subpoint 1, ROU asset and lease liability, subpoint 2, you will have PPE and the corresponding provision for site restoration, PP and the corresponding provision for site restoration. Okay, so that is what they mentioned. They are just saying that you are narrowing the scope of initial recognition exemption as per the amendment to paragraphs 15 and 24 of Ind AS 12, as you can see over here. exempt an entity from recognizing a deferred tax asset or liability in particular circumstances at the date of transition to Ind AS, a first-time adopter shall recognize a deferred tax asset to the extent that it is probable that taxable profit will be available, against which a deductible temporary difference will be utilized, and a deferred tax liability will also be created, which is associated with the right of use asset and lease liability and decommissioning and site restoration liabilities, and the corresponding amounts recognized as a part of the cost of the asset. So, I mean, they are saying that as per the amendment, despite these paragraphs that exempt an entity from recognizing, so they are exempting from recognizing deferred tax asset or liability in certain circumstances because they are exactly offsetting each other. 101 says that a first time adopter shall recognize a deferred tax asset to the extent it is probable for right of use asset and lease liability, decommissioning and site restoration obligations along with the cost of PP. So even if they are kind of offsetting, you will still kind of recognize. Okay, so this kind of takes care. So over here in summary, if I were to just round this up, the amendments on 31st March 2023 come into Ind AS 1, where instead of significant accounting policies, you are looking at material accounting policies. These are policies that have to be disclosed, which according to you are going to impact, influence the decisions, and along with that you also have to show reasonable judgments. They give you further clarity on accounting estimates. Earlier we only had the definition of changes in accounting estimates. Now accounting estimates themselves have been defined, but there's no really change in the essence of that definition, that these are monetary amounts where you have a certain degree of uncertainty. A few examples have been added like depreciation or Ind AS 37 related provision for warranty, NRV, fair value, etc. Next you look at Ind AS 12, where an exception has been added in you requiring to create a deferred tax asset and deferred tax liability on items which at initial recognition itself kind of offset each other. So rather than creating a deferred tax asset or liability, an exception is given if you don't want to create. And Ind AS 101 narrows that scope and says, well, you know what, there is an exception which is there. However, at the stage of initial recognition, it is advisable if you do create a deferred tax asset and liability, at least in case of ROU asset lease liability, as well as PP and corresponding provision for site restoration. Now, apart from that, the two other items which were earlier covered, I'm just doing a quick roundup. First is for CSR. One of the amendments that was there, and this CSR amendment is obviously applicable now for the November 23 exams only. Beyond that, CSR is not even there in your syllabus. So over here, CSR first is the constitution of a CSR committee. One of the requirements was that CSR committee is constituted if your CSR spending is greater than 50 lakhs. Over here, if there is any amount in your unspent CSR account, you still have to keep the CSR committee irrespective of whether your amount is more than 50 lakhs or not. That is the first thing, constitution of CSR committee. Second is the omission of rule 2. Now there was a certain degree of ambiguity on this, but I think the language at least that is used over here is fairly clear, and the institute study material has not put in any change, so we will follow this language. So the requirement typically was when you are entering into CSR, you have to look at the immediately preceding financial year, but when you are exiting CSR, you have to look at the immediately preceding 3 financial years. If your limit are not crossing the immediately preceding 3 financial years, that is when CSR is going to be removed. Now, rule 3, if you go to see, has been omitted. Now, a school of thought was if rule 3.2 is omitted, that means even for exiting we have to look at the immediately preceding year. No, for exiting still you will continue to look at the immediately preceding 3 financial years. So then what is the interpretation of rule 3.2 being omitted? The interpretation that the institute at least has given over here is that rule 3.2 says that you don't have to constitute a CSR committee. It says that if in the last preceding 3 years, if your limits have not crossed, you don't need to constitute a CSR committee. That rule is omitted because even if there is some amount lying in your unspent CSR account, you still have to constitute a CSR committee for the same. So if you go to see over here, rule 3.2 required that every company that ceases to fulfill the criteria under 135(1) for 3 consecutive financial years is not required to constitute a CSR committee. So they are focusing only on the CSR committee, not on the applicability or non-applicability per se. Now as per the amendment, this rule has been omitted because even if there is any amount lying in the unspent CSR account, you still have to keep on maintaining the CSR committee. That is what the interpretation is, and hence the solutions continue to remain what were there in your existing study material or in the notes or sums that you would have done earlier in class based on the institute's interpretation. Now there were certain things regarding implementation agencies, so who is responsible for implementation, and we had said that a few more agencies have been added, like hospitals, certain eligible charitable institutions, certain eligible religious institutions, certain eligible universities, which are allowed as per section 1023C of the Income Tax Act. So maybe charitable institution, maybe a trust or religious institution, or university or hospitals are permitted. Limits of expenses incurred towards impact assessment. Remember, if you are spending more than, I think, 10 crores or so of CSR, then you have to carry out an impact assessment. Someone has to say that what is the impact of the CSR work that you have done, and for that impact assessment on a particular project, there were certain limits mentioned that the amount for carrying out that impact assessment can be treated as eligible CSR, provided it is within 50 lakhs or I think 5%, whichever is lower. 5% of the CSR spend or 50 lakhs, whichever is lower. Now that has been changed to 2% or I think 50 lakhs, whichever is higher. So again, I would not really read a lot of this, at least from an accounting standpoint. It is more for a legal implication rather than accounting. Disclosures, you have to give an executive summary. You just have to give the disclosure of the overall CSR. You don't have to give project wise, and additional disclosure which is required for the unspent CSR account. This were little bit of disclosures regarding the reporting. Next, you had amendments which were applicable on 23rd of March 2022. That is more than a year and a few months away. So we'll quickly discuss this, what was mentioned over here and which was earlier also the case. As a quick roundup, was under Ind AS 16, if let us say you are doing some testing and you spend 100 rupees while testing the PP, and you got certain products which you could sell and get 80. What do? Well, you separate 80 from the initial recognition value of the PP, directly attributable. But what if you get 120? That is 100 spent at 120. Where will the remaining 20 go? That remaining 20 will still be reduced from the cost of the PP. You will, so 100 of testing minus 120, you will not take that 20 to the profit and loss account. That is the first part. Second, under Ind AS 37, while determining onerous contracts, cost of fulfilling a contract includes what? They've given you clarity. It includes directly attributable expenses as well as allocable expenses which are linked to fulfillment. So they've given you certain guidance on directly attributable cost as well as costs which are allocable. So both of them are taken under Ind AS 103. There's no specific change per se. They've just kind of given you a clarification regarding conceptual framework which has come. So as per Ind AS 103, if you have items like contingent liabilities, etc., you have to record it at fair value, irrespective of what is happening in the individual accounts. However, there is an appendix to Ind AS 37 which might mention that there are certain levies which have to be recorded as per the guidance in that appendix. Now what might happen is you might record a liability if I am taking over the levies, etc., of the other company, and then on the application of the appendix, these levies have to be immediately derecognized. So the standard says over here that if a particular liability is recorded as per Ind AS 103 at the stage of recognition, going forward as well, you will continue to record it at an amount which is the higher of the payment to be made, or the amount that is recorded at 103, whichever is higher. This is the same thing that was even studied when we studied Ind AS 103. So as such, it is more of a clarification regarding a particular appendix for levies, though it is not really very significant from an exam standpoint. The treatment remains the same. Under 101, they have given you an additional guidance for items like FCTR, foreign currency translation reserve. Usually FCTR is reset to a zero value or it is retrospectively restated. However, there's an exception which is added over here, that if there's a parent company and there's a subsidiary is already moved to Ind AS, maybe the parent is NBFC, subsidiary is other than NBFC, it has already moved to Ind AS and prior to the parent, and now the subsidiary's financials already have an FCTR. Now if parent is transitioning to Ind AS, then the subsidiary's FCTR, there's an additional option which is given that the subsidiary's FCTR can be continued rather than resetting it to zero value or retrospectively restating. That additional option is given under Ind AS 101. Under Ind AS 109 for financial instruments, they've just given you certain clarifications in case of modification or extinguishment accounting, that we say transaction cost. So what will be included in the transaction cost? Any amount paid to or on behalf of the lender, is a transaction cost, for example. So it is just clarificatory in nature. I would say that it would remain exactly the same. It is from a student standpoint, even if this was not specifically mentioned. And when you look at Ind AS 41, when you look at cash flows, these cash flows are after tax cash flows. So when you try to value a particular biological asset, sometimes you might have to take the present value of future cash flows. While doing so, the cash flows will also include tax, and hence then post-tax cash flows should be taken for the purpose of this assessment. So these are the amendments. Again, you could gauge, if you are listening to this video by now, that these are not having very far-reaching consequences and almost nil consequences on the problems that you would have practiced. But yes, it is always good to know the changes from an exam perspective. Just be kind of broadly conversant with them and proceed further into your main exams. Okay, so that takes care of a holistic discussion of November 2023 RTP. I really hope this video has been helpful. If you have any feedback or any comments, please do write in the comments box, and I'll try to kind of meet you more often with more videos. If you need any specific help or any specific section where you want kind of videos or voice notes or something of that, please do let me know, and we'll try to incorporate it to the best extent possible. That's it then. Thank you very much for your time and your patience. I'll see you soon, and till then, good luck, goodbye, and study hard.